The balance sheet is certainly much larger than it was in 2014 or 2015 when they last ended the QE in the last cycle and when they raised rates last time. But there's a lot of uncertainty about what it means to actually reduce the size of the balance sheet. The federal funds rate is a well-tested tool. They have a sense of what it means for the economy when they raise interest rates, how that affects growth, how that affects inflation. And so, that's a balance that policymakers have to weigh. Do you reduce the balance sheet sooner and potentially run into consequences like they saw in 2018, 2019 when they went a little bit too far? Or do they keep with the tools that they know more closely, like the federal funds rate, in order to tamp down on inflation?
Robert, I see two camps right now. And in the one camp, there's a group of people, which I'd include you in, that believe the Federal Reserve is building in flexibility to have some optionality through next year, depending on what the data looks like. There's another group who believe the winding down of QE, the acceleration of the taper, is just about building us up for a straight line towards a rate hike. How do you draw a distinction between those two camps right now, Robert? What's guiding you towards the former and not the latter?
Well, it certainly could be either or, right? The optionality is to open up the space that if the Fed does need to tighten policy more rapidly than anticipated next year, ending the taper sooner certainly opens up that optionality. So I don't think that they're mutually exclusive, but the key, what it comes down to, is inflation. Our view is that inflation is likely to moderate. We think, particularly on the goods side, particularly on the supply chain side, that we're starting to see early flashes of light at the end of the tunnel that could mean that inflation does sequentially start to slow down as we're moving through next year. Especially in the early part of next year, that's going to take the pressure off of Fed policymakers, and that's what can give them a little bit of space to take time after the end of the taper to really take stock of how the economy is evolving and really assess what next steps are needed for monetary policy. But if the data surprises from our expectations and inflation remains firmer for longer, then policy certainly remains data dependent. And I think that's the key when it comes to this optionality approach, is get the taper done sooner, watch the data, and let the data, and particularly the data on inflation, dictate what policymakers do with interest rates and with the balance sheet as we move through next year.
If you want that flexibility, then do you need to outline what the sequencing of policy is now? Do you need to get that done beforehand and much, much earlier, i.e. this week?
That would be appropriate. And I think it's important to remember, as we were getting near the end of the last taper in 2014, the Fed put out its policy normalization principles and plans, which laid out broad brushstrokes of what policy normalization would look like, how the Fed would operate with its balance sheet, hold no more reserves than would be needed to conduct monetary policy efficiently over the long run, all that good stuff. And so I think it would be appropriate to start to see that conversation coming together, perhaps at this meeting, perhaps at the January meeting. But certainly, if they are going to be wrapping up the taper in March, over the next few months, it would be appropriate to get more information on that conversation to see how policymakers see this all coming together.
And of course, Robert, we all wait and listen and want to see what the updated expectations for the economy, for inflation, are going to be coming from the Fed. And I'm interested in the nitty-gritty within that inflation number. I mean, we're paying too much lip service to Bill Ackman today, but again, on the weekend, he was worrying about the shelter and how really inflation push that is at the moment. What do you make of shelter, and are we factoring it in enough?
It's a critical part of the inflation outlook, so I don't think we can spend enough time talking about shelter inflation. We focus a lot on what's been going on with supply chains and how that's been pushing up inflation, core PCE inflation, which matters importantly for the Fed. We think that all things considered is likely to hit 4.5% in the November print. So it's very elevated. Go back to those economic projections that the Fed's going to put out. We're likely to see some substantial upside revisions. When you start to look into next year, even if you maintain a view that supply bottlenecks are likely to ease, shelter prices, firming shelter prices, and firming services prices overall, that's what's going to very likely keep inflation above 2%. So it's not going to keep us at these peaks in the 4% range, but it is going to keep inflation pretty well supported as we move through next year, even if we're on a slowing trend off these peaks overall.
And slowing trend, perhaps in inflation. What about slowing trend in the economy overall? I'm thinking of the whiplash that I'm getting here in the United Kingdom from a Bank of England that seemed to be very hawkish but a month ago, and has completely reined back from that from a market expectation because of Omicron. I'm reading a headline now, UK Boris Johnson's the Prime Minister of the UK, talking about how at least one person has died in the UK of Omicron now. How much of a headwind is that to the economy, and could we see some sort of reversal in the hawkish tone coming from the Fed?
Well, I don't think we can totally dismiss risks from Omicron when it comes to the economy, but I do think we have to look at where the economy is positioned. And our view is that the economy is fairly well positioned to move through these headwinds, that the consumer in particular is a strong, it has a strong foundation. When we look at Delta as a guide, we might see some shifts in the composition of consumer spending towards goods away from services. We've seen, throughout Delta that they can put a dent in job growth, but the aggregate position of the economy remains strong. And, we're growing, we're tracking roughly 8% annualized growth in the fourth quarter. We know that the economy is likely to moderate off of that growth. That's a very strong rate of growth. But we don't think it will do so in a way that will really deter the Fed here. And particularly as the Fed is focused on the medium term, I don't think there's anything recently that has come up to dissuade them from the notion that, yes, we might see near-term effects from the virus on growth in the winter. To a certain extent, that was to be expected, that we would see a winter wave. If it's worse than expected, they can adjust. But they've seen that when you look at the medium term, on the other side of that, temporary pullback is very likely a sharp bounce back that they need to be prepared for as well.
Robert, thank you. As always, sir, it's good to hear from you. Robert Rosen there of Morgan Stanley on the Federal Reserve and the road ahead through next year as well. That headline, Caroline Hyde, let's go through it again. The Prime Minister yesterday evening with some really emphatic, dramatic words, expecting a tidal wave of Omicron infections. And there's the headline, Caroline, at least one person has died in the UK from that variant.
John, anecdotally, I've never known so many people with COVID as I do now here in the United Kingdom. It becomes an anecdotal perception because it's up to you as to whether you still want to travel. It's up to you as to whether you're still going to be going to any Christmas events, going to restaurants. It has a real impact on the economy, and clearly the Prime Minister is worried about it here in the UK.
And Lisa, ultimately, still waiting for a fuller picture from the people that matter before we set the policy. The policy, of course, being set first because they're worried about what it could be. But how contagious is it? How deadly is it? And how well does it escape vaccines? We're getting a picture slowly, but not that full picture that many people want to see.
So can the Bank of England remain on hold despite some of the inflationary pressures if there is sort of a motley picture when it comes to the statistics?
Goldman thinks they skipped this week.
Yeah.
Credit Suisse, I think it was at SocGen. I think SocGen and Goldman, they think they skipped this week and we maybe convene again in February.
Let's see. Unreliable boyfriend.
Maybe the year ends Wednesday, not Thursday.
No, unlikely.
You're going to stick with the ECP, are you?
I'm going to try.
All right, 157.52 on 10s. All-time highs in the equity market from New York, a beautiful one in New York City. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The UK's health minister says once again the country is in a race between the vaccine and the virus. Sajid Javid has detailed plans to offer all adults in England a booster vaccination by the end of December. Javid also said there is no certainty the government will be able to keep schools open. Meanwhile, the biggest airlines here in the UK are asking the government for economic help. New travel restrictions threaten to disrupt the peak Christmas season for a second year in a row. The CEOs of British Airways and Ryanair were among those writing to the Prime Minister Boris Johnson. They asked for emergency economic packages. Senate Majority Leader Chuck Schumer insists the Senate will pass President Biden's $2 trillion tax and spending package before Christmas, but time is running out, and Democratic moderates will still not be on board with draft proposals. A delay in the new year could hurt momentum for the Democrats. Pfizer has agreed to buy Arena Pharmaceuticals in an all-cash deal with a total equity value of $6.7 billion. Arena's portfolio includes development stage treatments in dermatology and cardiology. The company shares almost doubled in pre-market trading. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
is an extra $1 trillion in spending, not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we frankly have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street.
Influential.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer.
If it becomes necessary to get yet another boost, then we'll just have to deal with it when that occurs. But I'm hoping from an immunological standpoint that that third shot of an mRNA and the second shot of a J&J will give a much greater durability of protection than just the 6 months or so that we're seeing right now.
Dr. Fauci on a vaccine effort in the United States. From New York City this morning, good morning. Lisa Bravitz, Caroline Hyde, and Jonathan Ferro. Your equity market is up 11 points on the S&P, advancing 0.25%. The biggest week of gains going back to February as we closed out last week. A gain of 3.82% on the week. A monster week. Yields in a basis point on 10s to 147.35. Crude coming in 0.5% to 71.28. And the focus right now on the pandemic. Prime Minister Boris Johnson saying Omicron represents 40% of COVID-19 cases right now in London, and by tomorrow it will become the dominant strain. Joining us now to discuss is Joshua Sharfstein, Vice Dean at the Johns Hopkins Bloomberg School of Public Health. Joshua, let's start right here. Trust. How much trust is there of these politicians delivering these emphatic statements and scaring society? And that's the issue we have right now, isn't it, sir? Who should we trust? And how long do we have to wait to have some data, some numbers that we can trust?
Well, I think that, the numbers themselves, how many cases, what percentages are of Omicron, those are true. The governments are saying. Unfortunately, there's some percentage of the population that has tuned everything out. But I think most people realize that this is a new variant, just like Delta was a new variant, and we're going to have to respond accordingly.
Given the fact that Omicron is now expected to become the dominant strain in the United Kingdom, as Boris Johnson was outlining this morning, is the third dose, is the booster shot going to be considered required in order to be fully vaccinated?
I think that is becoming a distinct possibility with each study that comes out suggesting actually good news, which is with 3 shots of the mRNA vaccine, people have a reasonable degree of protection from Omicron. This is not the case of complete escape from the vaccines, but that third dose seems to really help. And that may, in fact, change some of the policies about what's considered fully vaccinated.
So far, companies have really led, private companies, when it comes to setting policy. You see in the United States, a survey of companies actually shows that nearly 2/3 of all of them are going to mandate vaccines for their workers, whether or not there is any sort of overarching law about that or policy. How have you seen the discussion changing among private corporations to get that third shot, the booster, as part of the requirement?
Well, I think the recognition right now is that to have a safe workplace, which people want, you really can't, open up to Omicron, and doing things that are necessary to prevent this virus from getting into the workplace, spreading in the workplace, really wreaking havoc on all the plans that companies have, is, a priority, doing something to prevent that. So I think that companies are looking at the data just like public health officials are looking at the data, and it wouldn't surprise me if they start requiring the third shot. I mean, the third shot is very safe, and it protects against Omicron, so it's pretty logical that we could get there.
You talk about wreaking havoc in terms of the workplace, wreaking havoc on travel plans ahead of the holidays as well. And I'm seeing, of course, Prime Minister Johnson saying that the UK has a ready supply of COVID lateral flow tests. It's interesting from a cultural perspective, coming into the UK, everyone is testing every single day using these lateral flow tests that are being given out on the street or you're into your nearest pharmacy. How is testing distinguishing itself as I'm looking at airlines fighting back against more PCR testing because of the length of wait and the hoops you have to jump and the price tag? What other testing could they do?
Well, I mean, they could be doing the antigen testing as well. I mean, I think that we now are at a point where, with the virus sticking around and, making itself the unwanted holiday guest, it's really important to have testing, but to integrate testing into our lives. And PCR testing isn't that great for that if you've got to wait an entire day. Because even if you were negative, something could have happened in the interim. And so these antigen tests offer the opportunity to do things quicker. I don't think we've really figured out completely, particularly with travel, how to integrate it into our routine. Just like, not too many years ago, we integrated all the security stuff into our routine. We have to integrate testing for a while into our routine. And, we're in a little bit of a rocky phase while that gets worked out.
And this is what everyone from an individual perspective worries about, and it becomes a macro issue if everyone starts to worry. Prime Minister Johnson saying, look, he declines to rule out new COVID curbs before Christmas. It's an important family moment, but it's also an important economic moment for spending, for consumer sentiment. How likely are we to see further lockdowns in the United States and worldwide?
I don't think we're likely to see, full lockdowns unless we have a situation where there's just an incredible surge in hospitalizations. And, we don't yet have evidence that Omicron is going to cause that in highly vaccinated populations. So we are going to have to see. If that were to happen, and of course the healthcare system were to come, be at risk, then probably all bets are off on the kind of restrictions that might be necessary. But probably we'll see very, very limited and targeted policies to reduce the spread. Again, it's the uncertainty that gives everyone anxiety, but we are not back in March 2020. We have vaccines that provide protection. We know a lot about the virus. We can find it. We can test for it. So I don't think that people have to be so worried they're going to be watching a replay of last year.
Doctor, just quickly, how much more time do you need personally to conclude that this is less deadly than previous variants?
Well, it really, there are a lot of different views out there. I think a very strong argument is we need to see how it behaves in different populations. And so I think when you see, for example, London, when it really does become, the dominant variant, looking at what happens to hospitalizations, I think will give a really good view for the United States, what the likely outcome is. Highly vaccinated population, getting Omicron spreading around, does that really make people very sick? And we'll find out soon.
Joshua, thank you, sir, for catching up as always. Joshua Schaufstein there of Johns Hopkins. To pick up on what Caroline said, Lisa, the Prime Minister was asked 3 times, reportedly, will he rule out further restrictions before Christmas? Refused to address the question.
Even though there is so much that is unknown, just picking up on what Dr. Schaufstein was saying, that it's going to take so long to figure out whether this is indeed a less deadly strain. So we don't know that. This could actually be the circuit breaker for COVID, some people have speculated, if it is not very deadly, if it is something that causes, just cold-like symptoms, because then people get it, they get the immunity, and they don't go to the hospital, they don't get sick. And that, to me, is really a key issue.
Those headlines coming out of the UK this morning, Caroline Hyde, the Prime Minister, saying Omicron to become the dominant strain in London by tomorrow.
A phenomenal pace, and interesting the pace of reaction function coming from some of the industries that don't want to see tougher regulations in place, don't want to see their industries hampered, or indeed need more fiscal support. We're all talking about monetary policy this week, but the airline sector here in the UK is saying we might need more economic help if indeed you still stand by these PCR test rules and some of the tougher ways in which we get in and out of the United States and the UK, John.
Travel stocks lagging in Europe this morning, negative by 0.75% on the Stock 600. On the S&P right now, up 13, advancing 1/3 of 1%. There is a lift in this equity market. Over the last week, we just delivered one of the biggest week of gain to the year year so far, going all the way back to February, going into Fed decision week. Yields in a basis point to 147.52. We're at all-time highs, Lisa.
It just doesn't feel like it, though. But I mean, honestly, it's been that way week after week. It doesn't feel like it.
It's been so volatile, it's felt really bad, yet your equity market is back at a record. From New York City, heard on radio, seen on TV. On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the quarter three was the quarter that was most affected.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
It is time for the Fed to adjust.
This is a very difficult spot for them.
Every time we get close to a Fed tightening cycle, markets tend to get really aggressive.
And the bond market is really telling everyone a strong message, but people don't want to believe it.
The flattening yield curve is suggesting that it won't take much to break something.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Fed Decision Week from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. Together this morning with Caroline Hyde. Your equity market up 12 points on the S&P. What a week to have a record high at the start of this week, Lisa.
I got to say, I was looking at a Bank of America credit investor survey for the month of December, and it showed that the top risk was a policy error. Not COVID, not a recession, not a market sell-off, but the Fed doing something wrong. What does it mean to do something wrong? Move too quickly or wait too long?
What does it mean for this equity market? What's driven stocks this year? Earnings. Earnings have been fantastic. Margins have held up really well. Will that be the story going into next year? And that's the issue that we've got in this market at the moment. Earnings and a multiple. The multiple, will it be impacted by this conversation we're having about the Federal Reserve?
And especially at a time when people are just worried about the policy error and the policy response. If earnings keep up, how can people keep away from stocks given the fact that bonds really are offering nothing, offering the most negative returns going back decades when it comes to a real basis when you factor in inflation?
I keep saying the year is over on Wednesday. Caroline Hyde will remind me the year is over on Thursday, perhaps, if she agrees with my point of view that it's over after this week. The Bank of England, the ECB. Caroline, just around the corner.
What about the poor BOJ on Friday? Or Russia? You've got to get global in that perspective.
Fair to say, I think we could skip the BOJ unless you think something dramatic is going to happen.
They ain't going to say anything. Oh, maybe they'll just shut the market. But you're right. I think it's interesting that this has got a week where we have not one, not two, not three, 20 central banks updating their policy-making decisions, trying to factor in where inflation goes, how much of a risk it is. And that narrative, as Mary Daly was so clearly saying, sort of from the Federal Reserve over in the United States, saying, look, now, what is an impact on the consumer? It is inflation, actually. It's a regressive tax in many ways, and that now becomes front and center rather than the labor market.
Now I've said that, the BOJ is going to move markets on Friday, isn't it, Lisa?
100%.
It's going to shake up global markets everywhere.
Literally, you're going to end up with the most eventful Thursday and Friday ever in the history of markets.
I won't be here for you to throw mud at me. Equities up 10
You'll call in.
on the S&P. I'll call in if the BOJ makes a move, all right? Up 0.2% on the S&P 500. A lift in this equity market, a record high at the close on Friday, the biggest week of gains since February. It's in a basis point, Lisa, 147.35 on 10s and euro.
About whether they're going to make a move this Thursday. Bank of England releases a financial stability report and stress test results at 12 p.m. Eastern, 12:30 p.m. They're going to have a press conference. How much is the stress going to come from inflation versus a move too quickly? The Bank of England tightening into a slowing economy. I am curious how they game that out as they test some of the biggest banks in the country. Today, we also get an OPEC monthly oil market report. This comes after the biggest weekly gain going back several months, and it comes at a time when the Iraqi oil minister came out. And then at 9:30 p.m., State Secretary Antony Blinken will give a policy speech in Jakarta, Indonesia, that may be a formal description of what their approach is. But how much, again, is the idea that they need to diversify the supply chain issues? How much does that really bear out with respect to forming relationships?
Apple in the pre-market approaching $3 trillion. $3 trillion. Market cap, Apple 181.29, up 1%. Caroline, coming into this week, 2.94 trillion. Dan Ives of Wedbush saying hitting 3 trillion, another watershed moment for Apple as the company continues to prove the doubters wrong. That number could be just around the corner, around the opening bell.
I mean, wasn't it just a couple of weeks ago we were all wringing our hands, Apple down 2, 3, 4% because of their supply chain headaches, because of perhaps the fact that we wouldn't actually buy our iPhone 13, would wait, would push it off, we'd get the 14 instead. But it seems as though that supply chain issue just put to one side. Is it a haven trade of last week? Is it that you want to be getting into big tech still? But amazing that we go 200% higher since the offset start of COVID.
I said this earlier, trillion.
Now, I mean, honestly, who isn't a $1 trillion company now? Honestly, I will say I did have to explain to my children supply chain disruptions because they were wondering where their Apple products were after ordering them weeks ago.
That'll work.
There is, it didn't dampen their desire for it. It just increased the irritation if they're asking for it consistently.
They understand it.
They understand it fully.
They understand it now, just through Apple. Makes sense.
Flowcharts.
Christian Glissman joins us now, Managing Director of Portfolio Strategy at Goldman Sachs. Christian, back, and here we are with equities at a record.
Next year, and the question is, how much tougher? Is it going to be the monetary policy tightening side, which is going to put a bit of a speed limit? Is the growth picture breaking away because of Omicron? What's the new cycle narrative? I think where we come out is that at the margin for most of next year, you probably will still have above trend growth, and real yields in the back end will remain pretty low. So net, you probably want to be a bit overweight equities, a bit pro-risk in your asset allocation, but definitely going into the first quarter, there's a lot of question marks, and we certainly feel that investors have very little appetite to do significant shifts right now.
Christian, a couple of weeks ago, you came out and you said that the sell-off that we were seeing didn't look over, that it seemed like there was more to go. And everyone thought that it was a dip and it was buyable, and here we back are at record highs. What's your view in the next couple of months in terms of the correction that a lot of people have been saying is overdue, yet never seems to come?
Yeah, listen, I mean, as I said, as long as real yields are so low, there is a certain amount of search for yield and dip buying behavior. And similarly, the levels of growth in the US is running incredibly strong. The more the kind of mix of real yields and growth is deteriorating, the more difficult it gets to buy a dip. And what we said at the time, you remember, like when you do definitely see that sentiment surveys have had a significant leg down, so that's good. I think you've seen the positioning in options turn a bit. But at the margin, we have to be completely honest, we've seen the largest inflows into equities on record this year. So at the margin, most of the clients we speak to are probably a bit overweight equities, and they should be, as we said. From a strategic allocation point of view, bonds look particularly bad this cycle. So you should probably, in the back of your mind, aim for a bit of an overweight in equities. The problem is that in Q1, these type of overweights might be tested a bit just because of that interaction of Omicron with policy.
Christian, just quickly, is there a US bias within that overweight?
It's really interesting. I think we had kind of this year a bit of a shift where people were definitely getting more interested in Europe from a slightly more longer term perspective, and in Japan, occasionally tactical. I would say there's still a decent US overweight and a decent quality bias. I mean, you were mentioning Apple before. I think a lot of these heavyweight quality companies, they will still dominate in portfolios. And that's just a matter of size, as you were saying, in terms of market cap, but also, yeah, I mean, at the margin, there's clearly a lot of cynicism on the kind of new cycle narrative. I think we all know the COVID narrative and how much that can potentially keep growth above trend next year. Yeah. But we don't know exactly how green capex, infrastructure, deglobalization, income inequality shifts, all of these things are going to create the new cycle. Europe could very easily be a bit of a beneficiary there.
Christian, great to catch up. As always, Christian Müller-Glissman there of Goldman Sachs. Speaking of size and the weighting on the S&P 500, Lisa, north of 7% now. Apple makes up north of 7% of the S&P 500.
And it seems to be growing. I mean, honestly, this is the amazing thing. A lot of people have been wondering if it's saturation, if it's perhaps gotten to its peak. No, $3 trillion. Dan Ives has been on the forefront, and he continues to be.
Talked a lot about what rates might mean for this equity market. Mentioned the word from Jonathan Golub in Credit Suisse. We highlighted the strong relationship between CPI and S&P 500 profits. Historically, this benefit to earnings is offset by rising bond yields. In the current environment, Lisa, this is the important piece. Inflation is not translating into higher rates. That's your huge benefit for stocks.
Higher rates on the long end. I mean, yeah, you're getting a bit of a lift in the front end, but not the...
From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Boris Johnson is warning that the UK faces a tidal wave of Omicron infections. In an address to the nation last night, the Prime Minister set a deadline for the end of the year for the country's booster vaccination programme. The number of new Omicron cases here in the UK almost doubled on Sunday from a day earlier. Meanwhile, a new study says that 2 doses of the Pfizer and AstraZeneca vaccines induced lower levels of antibodies against the Omicron variant. Researchers at the University of Oxford say that increases the risk of COVID infection, and it underscores another finding released by the British government that emphasises the need for booster shots. In Kentucky, the death toll from the tornadoes on Friday may be less than originally feared. Still, at least 50 people are believed to have been killed. Kentucky's governor says more than 1,000 homes were destroyed. The storms killed at least 14 people in 4 other states in the South and Midwest. Foreign ministers from the G7 nations have warned Russia to de-escalate its military buildup around Ukraine. If not, they say Moscow will face massive consequences. The US and its European allies are also considering sanctions that would target Russia's biggest banks and its foreign exchange access. Vladimir Putin has denied he has any intentions to invade Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
To cut emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
For breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The CBO says it's not paid for. It's $3 trillion of deficit spending. It's not $1.75 trillion over 10 years is $4.9 trillion. What does this mean? The House should revote. And you know why I wrote a letter to CBO? Because Joe Manchin came to me and he said, I think this bill is full of gimmicks.
Senator Lindsey Graham of South Carolina from New York City this morning. Good morning. Lisa Abramowitz, Caroline Hyde, Jonathan Ferro, your equity market up 10 on the S&P. TK back with us for Fed Decision Day in a couple of days' time. Up around about 10 on the S&P 500 and up a third of 1% on the NASDAQ 100. There's a lift in this equity market, another 0.2% higher on the S&P. Yields in a basis point to 147. Senator Lindsey Graham saying the following, Lisa, this is a 1-2 punch to build back better. He was responding to inflation on Friday. It was interesting to see how the market responded in a very different fashion to say how politicians responded to that print on inflation in America.
Well, perhaps the inflation read will affect the likelihood of this getting passed, but frankly, the 1-2 punch might just be the Democrats can't get on the same page. I mean, absolutely about anything. The fact that we're still talking about SALT deductions, that we're still talking about capital gains taxation, how much this gets applied when we have 2 weeks that are basically non-weeks left in the year tells you what you need to know for a 2021 passage.
Well, you know what else you need to know? It's all in a sentence there from Senator Lindsey Graham. You've got a Republican senator invoking the words of a Democrat, Senator Joe Manchin, and that right there, Lisa, that's the issue.
The fact he's not going to get on board for a lot of these provisions, and frankly, it's not clear he even wants to get this done this year, considering the fact that inflation is going to be probably one of, if not the key debate issue when we head into the 2022 midterms.
Emily Wilkins joins us now of Bloomberg Government down in Washington, D.C. Emily, we closed out last week with an inflation print. Down in Washington, D.C., that's still shaping a conversation, isn't it?
Absolutely, because right now, everything really focuses on Senator Joe Manchin and to a certain extent, Senator Kyrsten Sinema, the two holdouts in the Senate on getting through President Biden's social tax and policy bill. And so those are the ones that are really going to be the focus of this week, and everyone knows it. As you saw, Senator Lindsey Graham saying he requested the report after Joe Manchin suggested there might be budget gimmicks, Republicans jumping on that report when it came out on Friday, showing that that bill could add up to $3 trillion in inflation. You also saw President Biden saying that he's going to be meeting with Manchin this week. And you've actually seen a number of outside groups launch ads in West Virginia targeting Manchin over the issue of this bill. So there's a lot of focus on Manchin right now. He has said explicitly that he does not want the bill to pass this year. He wants to wait till 2022. He wants to see what happens with inflation. But there's a lot of pressure to move now because there's the general wisdom in Washington is that once you get to an election year, it's much, much harder to get legislation through and to the president's desk.
So in the meantime, the president is tasked with trying to drive down inflation or message it correctly. They've tried both tactics, trying to drive down inflation with a strategic oil reserve release. How effective has that been by all accounts?
I mean, the White House will say that they still need sort of more time to see how that pans out. But I think we saw with the inflation numbers that were released on Friday that inflation is still a major issue. You know, President Joe Biden made the very bold prediction that last month's inflation numbers would be the highest that we would see. But we're already hearing other economists and experts saying that that's not going to be the case, that this inflation is going to last well into 2022. I think there's simply a big question mark at this point about what it looks like, as well as what, if anything, Washington needs to do here. You actually have seen lawmakers start to focus on things like bills to address backups in the supply chain, doing what they can from their section of the U.S. to address some of these backlogs and bottlenecks. And so that's one potential thing they can do, but this really is a global issue.
Emily, I was really struck by Janet Yellen's comments last week, where she really sounded kind of like Donald Trump with respect to more protectionist types of policies and trying to get some of the supply chain back home, saying it was a national security issue. How much support does she have among other Democrats or even on a bipartisan level? And how much does this move the needle with trying to do something on a policy level to bring supply chains home?
I'd say she definitely has bipartisan support. And my reason for saying that is that the U.S. Senate passed legislation several months ago that would give $52 billion to semiconductors to be made in the U.S. to make sure that that very critical piece that the U.S. doesn't necessarily have to rely on foreign countries to produce that. Now, of course, that bill has not yet crossed the finish line. There are still debates between the Senate and the House because it's part of a much larger package. But it does show that there is bipartisan support for the idea idea of Made in America and for having the U.S. take some control over various supply chains. At the same point, it takes years and years and years for the U.S. to build up the capacity to produce some of these things that are currently made overseas. And there's also an acknowledgement that the U.S. can't just say, well, we're just going to build it here. In the short term, they're going to have to figure out ways to deal with the global situation.
All of that speaking to the inflationary push within the commodities space, the inflationary push that President Biden over the course of the weekend on NBC was trying to push against, saying, look, with the Build Back Better, you will get a cost of living cut. Is that really what he's going to be putting his eggs in the basket of, to try and push against the narrative that this is going to be inflationary in terms of the spending? Because we even have Mary Daly of the Federal Reserve herself saying, look, inflation is such a regressive tax.
You know, the White House has consistently said, and we've heard this message from other Democrats too, that because the bill contains so many provisions for workers, that ultimately in the long term, it will help the economy. The question, of course, is what happens in the short term. I mean, we only have elections in November of next year. Lawmakers are keenly aware of that and keenly aware of what sort of timeline they are on for this legislation having an impact. At the same point, you know, the inflation debate, it's very valid. It's absolutely happening in Washington. At the same point, lawmakers, particularly Democrats, are cognizant that they have promised their constituents a number of the policies in this social spending and tax bill. They don't want to go home empty-handed, and should inflation wind up subsiding midway through 2022, they feel like they need to have something to run on beyond that bipartisan infrastructure bill that they feel has a big impact on people, thinking of that child care tax credit, thinking of healthcare expansion, thinking of climate policies. Democrats see it as the sort of their one chance to get it done. They've got the keys to the car. They want to make sure they're getting it across the finish line.
Emily Wilkins of Bloomberg Government down in Washington. Emily, thank you. Lisa, one good piece of news. We're not talking about the debt ceiling going into Christmas. That would have been the one thing that would have kept people down in D.C. working well into the holiday.
And not just the idea of a shutdown, right? We've seen that before, but the idea of a default. And somehow we've gotten that off the table. So yay. Are you really celebrating? Do you really feel any excitement and relief?
I think it's some good news.
It is. No, it's
some relief.
It is relief. Then the question is whether they'll actually get anything done. And that's unclear in terms of the Build Back Better. Also interesting on the oil reserve release. No other country has really come out and shown that they also have released oil as they have agreed upon. So the U.S. right now is kind of alone.
I'm pleased you went to crude, though. We're negative on the session by 0.7 on both Brent and WTI. This came from OPEC in the last couple of minutes. They boost their first quarter demand view as the Omicron risk is seen as mild. Now, whenever, Lisa, you analyze a message, you have to think about the messenger. Granted, but still there's the headline from OPEC this morning.
I do wonder what they actually agreed upon with President Biden as they came to some sort of agreement ahead of that OPEC meeting.
If they agreed on anything.
Well, I mean, honestly, they've been changing their message, have they not?
All over the place.
I mean, they've been changing their message. They're going to stay the course, even though there are these risks.
Mike Collins is going to join us shortly of PGIM. Really interesting views coming out of PGIM that maybe you've seen the peak at the front end of this yield curve already. That's going to come next from New York City. This is Bloomberg.
front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Just for perfect transparency, Lisa complaining in the commercial break that she's not as gloomy as we suggest she is. So look out for the line of questioning with Mike Collins of PGIM coming up very shortly. From New York City this morning, good morning. On TV and radio, your equity market up 0.2% on the S&P, on the NASDAQ, up 0.4% on the Russell. Where are we? Basically unchanged. We're flat. Coming into this week at all-time highs on the S&P 500. 5,300, the most bullish outlook from BMO for year-end next year. 5,250, the call from Deutsche Bank that I saw from Binky Charter in the past week. That's the equity market picture. Here's the bond market story for me and something we can discuss in just a moment. 2s, 10s, and 30s. Right now, the difference between 2s and 10s is about 80 basis points. The last rate hiking cycle started at the back end of 2015. The spread between the two in at around 120 to 130. So, Lisa, I think you know where I'm going with this. Will they be willing to hike interest rates sub 100 basis points with a curve that's flattening like it is at the moment?
And this is the TD Securities argument. They're going to hold off. They're not going to raise rates as much, and they're going to get the long end creep up a little bit. They're going to allow a steepening, even though everyone seems to have a high conviction that the flattening curve is going to continue.
I know. And at the front end, that story as well. Yeah. Just how much have we baked in? How much have we priced? PGIM think that maybe we've seen the peak at the front end already. Mike Collins of PGIM coming up very, very shortly. That's the bond market. Finish on this in the FX market. Sterling, cable, sterling at 132.60. Lisa, the pound, negative about 0.1%. In the UK right now, I'm struggling to find the good news. And that's the difficulty for anyone who's long sterling going into the Bank of England this coming Thursday. Most people, Lisa, are pushing out that call of the Bank of England. It's interesting, though, this time around. Last time around, people expected a hike and didn't get one. And this time around, people aren't expecting a hike. I'm not suggesting they will get one. I'm just saying it's changed in the last month.
The problem is that inflation is still a real problem. UK natural gas futures actually rose to a new record high. They surged more than 10% earlier this morning on concerns about Russia and Ukraine. How do they counter some of the inflationary reads, given the fact that it is a slowing economy and given the fact that there is the Omicron variant?
The restrictions that could be coming or maybe not.
Right.
There was some frustration in the way we talked about Prime Minister Boris Johnson refusing to deny that maybe some more restrictions are coming before Christmas. What else is he going to say, Lisa? What else can he say to a question about can you rule out any further restrictions before Christmas? What can a leader say to that?
Yeah. I mean, he can't say, right. I mean, he can't say he's going to rule out, but I do wonder how much noise is being generated by his office to try to, distract.
Maybe get us talking about this and not quizzes.
I don't know.
You want to do the Christmas quiz this year? I can host.
Yeah, well, if we do that,
is that what you think that maybe he's trying to stop us from?
I'm just saying.
Just saying, of course. 132.62. 132.63 on cable. That's the cross-asset price action. Let's get you some single names, some movers this morning with Romain. Morning, Romain.
Hey, good morning, John. Let's take a look at some of the big caps. Of course, we're talking about record highs pretty much all around on the major indices here in the pre-market. Getting a little bit of a bump here from Pfizer. The share is up about 1.3%, announcing a deal to buy Arena Pharmaceuticals. Of course, a lot of people know that company for a lot of its cardiology and dermatology products. However, an executive over at Pfizer say they're more interested in that company's ulcerative colitis treatment that it's been developing. Says it actually plans to speed development of that. It's paying about $100 a share, $6.7 billion, about double what Arena was worth on Friday. Coca-Cola higher here on an upgrade by JP Morgan. The analyst saying that the company has actually recouped about 70% of what it lost in on-premises sales. And keep an eye on Apple, as everyone is, on that $3 trillion market cap watch. You need about a 1.5% close here on the day in order to get that $3 trillion level. Remember, it was just, barely a year ago, we were at $2 trillion, and about 2 years prior to that in 2018 when we got to that $1 trillion level. We should point out that a lot of analysts actually saw this coming. Remember, Dan Ives over at Wedbush, Jim Suva over at Citigroup earlier this year actually raised their price targets that implied a $3 trillion market cap. A lot of people called them crazy. That was a 12-month price target. Here we are 9 months later, staring down the barrel of $3 trillion. All right, flip up the board, guys, here. Some interesting changes coming at the end of the week in the NASDAQ composition here. They are reconstituting the index, 6 new stocks going in. That includes Airbnb and Lucid Group, Fortinet, and a couple others also moving into this space. Relatively newer companies here. Out, unfortunately, is Cerner, CDW, and Trip.com, of course, the big Chinese online travel agency, which has really gone nowhere all this year. So these are your movers here in the pre-market as we wait on that constitution. This will be reflected, of course, on Monday morning when you come in for trading 1 week from today.
Looking forward to the close. Romain, thank you. On Bloomberg TV a little bit later with the team. From New York then, futures up around about 10 on the S&P, up 0.2%. Apple and that $3 trillion market cap very much in sight. Lisa, I missed this from JP Morgan. They are the new big bull on the street looking for 210.
All right.
Wedbush and Dan Ives at 200.
Think we got to get Dan Ives back on. Is he going to go to 211?
We did ask him if he'd change, and he hasn't.
No.
Though at least he's been bullish the whole way up, basically, on this run, and what a run it's been. Mike Collins joins us now, Senior Portfolio Manager for PGIM Fixed Income. Mike, I promised we'd get to this call at the front end. You think that maybe we've seen the peak of yields at the front end and at the long end on 10s as well. Mike, just walk us through the framework at PGIM right now. When you all get around the table together, how you explain this?
Yeah, Jonathan, again, it's looking at the long-term view, right? And everybody's so caught up on this growth surge and on this inflation surge. And we've done a lot of work on this. And when you really peel it back, it's been more demand-driven than supply-driven, right? If you look at supply of stuff that's being made around the world and being shipped, it's higher in many places, in many cases, than pre-COVID. But the demand has jumped like 20%, especially for goods, for durable goods, for imports. That demand is going to come down, right? That big jump in the savings rate we saw last year with all the fiscal stimulus, all the helicopter money, that has already been spent. It's gone, right? So what's going to happen going forward as the fiscal stimulus really retrenches, notwithstanding these infrastructure and BBB packages, which I think are just really non-events in terms of their economic impact. It was the helicopter money sending people cash last year that really jumped spending, and that is going away, right? So the supply-demand imbalance is going to come back into balance over the next 12 months. So that's really the big picture. And the Fed, though, right, is kind of trapped. They're pinning themselves in the corner. They're going to hike rates because they see these headline numbers. So the front end is selling off. The back end is flattening, which happens every time you get a Fed rate hiking cycle. So I think the curve is going to continue to the point where it's totally flat. But that's already priced in. If you look at the 1-year note, Jonathan, in 2 years from now, which is reflected in the 3-year yield, not to sound too wonky on a Monday morning, but that's at 1.62%. The 10-year note, 10 years forward, is at 1.62%. So the market is already priced in a totally flat curve, which is ultimately what will happen when the Fed's done hiking.
Michael, you're talking about an idea that a lot of people disagree about, that you're going to see inflation come down enough that can justify the Fed's patience. How can you see their rhetoric this Wednesday kind of confirming that if, say, they do accelerate the taper, as they're expected to do, and continue to talk about uncertainty?
You know, they're not being patient, right? That's why the front end is getting killed here. I mean, 2s, 30s, this cycle, just earlier this year, peaked at around 230 basis points. I always look at 30s because, we are, manage a lot of long-term money for insurance companies, pension plans. They live in that 30-year space, not like retail investors. That was at 230. It's at 115 today. It's been cut in half. So it's halfway to zero, right? And it will get to zero. But again, that's already priced in. The Fed has turned really hawkish. They're getting really aggressive. They're going to accelerate their taper. They're probably going to pull forward and accelerate rate hikes. But ultimately, what's priced into that 10-year note and the 20-year note is where that funds rate is going to average over the next 10 years. And yeah, on average, it's probably going to be 1% or less. They're going to get it to 1.5. Maybe they overshoot and get it to 2 or 2.25 this cycle. But sometime in the next 10 years, Lisa, it's going to be back to zero, right? So on average, it's going to bounce around between 0 and 2, and it's going to average 1 or probably even less, which puts, 10-year notes at reasonable value here.
Michael, are you pricing in at all the risk that they might have to be more patient? I'm here in England, where the Bank of England was really hawkish, and now they're not.
Yeah, Caroline, good morning. That's the risk, right? There's so many priced in the front end now. Basically, 3 next year and 3 in 2023. That's a lot, right? That's a Fed that's really moving for 2+ straight years, right? That's a lot. That's a long time to try to price in and figure out what the economy is going to look like, what inflation is going to look like, and what COVID is going to look like. So you're right. One of the risks right now, I think the hawkish scenario has kind of been priced in with this really flat forward curve. But the risk is that you do get a big drop in activity over the next 6 and 12 months, and that inflation comes down a little more quickly than people think. And the Fed and other central banks say, we're not going to be able to hike 3 times a year. Let's pull that back. And then the curve, bull steepens, right? And we're not really ideally positioned for that. We're in the flattener, which has been working like crazy. But we're starting to cover some of that in because we are concerned about that risk that the Fed isn't able to hike 6 times, which is a pretty high probability for sure.
Mike, you always get me thinking. It's always great to catch up with you, sir. Michael Collins there of PGIM. Mike, you're the best. Thank you, sir. I've been lucky, and so have you, Lisa, over the years, to learn from some of the best. Alarian reader in the fixed income market. Something Mike Collins said to me years ago has just stuck with me. I asked him about 3-5 years ago, what would he think when we look back at this bond market in 10 years' time, looking back 10 years, about how crazy all this negative yielding stuff was? And he said, John, you will wish in 10 years, looking back 10 years, that you bought the 30-year with a 3% coupon. And here we are, down at 185.
And I don't want to give too much away, but in the break, he was talking about how we're going to go back down to zero at some point. And then I said, what about balance sheet reduction? And he said, who cares? It goes from 9 trillion to 8 trillion. It's going to go up to 20 trillion in the next 10 years anyway, right? And I was thinking, right? Is that really the base case? Okay, please go on. These are the discussions that are being had by bond strategists.
I'm not sure that's his actual call, but it gets you thinking.
But yeah.
Maybe, who knows, given what we've seen in the last 2.
Honestly, this is actually what a lot of people do think, because they think that the Fed's balance sheet has to keep up with the monetary supply, with the pace of issuance of treasuries. And honestly, that has seemed to be the trajectory over the past decade.
On this economy, joining us shortly, Stephen Stanley, chief economist at Amherst Pierpont. Don't miss that conversation with Caroline Hyde and Lisa Abramovich this morning. I'm Jonathan Ferro. Tom Keene back with us on Wednesday for that Fed decision. Going into that Fed decision, your equity market up another 0.2%. The S&P 500 at all-time highs. From New York City, heard on radio, seen on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Leanne Gerrans. The UK's health minister says once again the country is in a race between the vaccine and the virus. Sajid Javid has detailed plans to offer all adults in England a booster vaccination by the end of December. Javid also said there's no certainty the government will be able to keep schools open. In Kentucky, they are still searching for victims of the tornado that left a 200-mile path of destruction. Governor Andrew Beshear has lowered the death toll. Still, he says at least 50 people have died. In Edwardsville, Illinois, 6 people were killed when a tornado slammed into an Amazon delivery depot. 45 people made it out alive. Flight attendants in the US say alcohol is fueling an increase in in-flight violence by passengers. They're calling on airports to limit travelers' access to drinks before flights. Those comments may help to further the efforts to limit go alcohol sales at airports. Pfizer has agreed to buy Arena Pharmaceuticals in an all-cash deal valued at $6.7 billion. Arena's portfolio includes development-stage treatments in dermatology and cardiology. The company's shares almost doubled in pre-market trading. And Apple is inching closer to a $3 trillion stock market value for the first time. Shares are higher in pre-market trading. Apple is up more than 200% since the coronavirus first sent the world into lockdown, and that was last year. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever, but nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the US to the UK, and now it's open, of course, to UK nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
you're looking for the stock market to be the leading indicator of when the inflation problem is going to be, I think you're looking in the wrong place. I think you got to look to the bond market. And these rising short rates and the flattening yield curve, which is also, I think, a very worrisome sign that it's suggesting that the Fed's going to make a policy mistake. Usually the Fed raises rates till they break something.
Jim Bianco of Bianco Research, great to catch up with him recently. Going into that inflation print on Friday, 6.8% in America. From New York City, big week ahead with Caroline Hyde, Elisa Abravitz and Jonathan Ferro. Tom Keene back with us on Wednesday for that Fed decision. More still to come this week beyond the Fed. Futures up 9, advancing 0.2%. It's not just the Fed, it's the ECB, it's the Bank of England, and Caroline Hyde will remind you there are others too. Critty Gupta joins us now to look at the BOE and sterling. Morning, Critty.
Morning, John. Well, everyone's talking about the Fed, but I want to look at the Bank of England, I should say the BOE right now, because it's really those rate hikes, bets that I'm really interested in. The pound, we know, has been dropping. It's been weakening. It's been having a really rough time of it lately. A lot of that has to do with those rate hike bets being pushed to February and, of course, the Omicron variant impact. But my chart of the day shows the pound not on a spot basis, but on a trade-weighted basis. This shows a chart going back to those Brexit times where it's largely traded in a range for the last 5 years. And in 2021, notably traded at the top of the range. But here's something that a lot of people aren't talking about when you look at the pound's performance, and that is trade flows. Notably, the FT reporting that UK ports are seeing their worst year since 1983, and a lot of that has to do with two major factors. The first being, of course, oil volume. A lot of their port volume comes from 1/3 of oil volume that goes through London and into the rest of the world. But of course, with the coronavirus really impacting the demand picture, those UK ports just aren't seeing that. The other piece of the equation is that cargo volume, as a result of Brexit and those border controls, not going through London anymore, instead going through Ireland and then through the EU. The question here, though, John, is as you start to see the congestion really kind of release in ports around the world, and specifically in the UK ports, do those trade-weighted flows start to impact the pound in particular?
What a great question, Critty. Fantastic, going into the Bank of England this coming Thursday. Right now, I'm incredibly distracted by a series of Ryanair tweets, the budget airline in Europe. And once you start reading through this, the UK COVID alert level has been increased from level 3 to level 4. That was the news over the weekend. Ryanair have put forward this chart, this graphic, Lisa, which has the stage of the outbreak on the one side and then the Downing Street party level on the other side. When you're at level 1 and COVID-19 is no longer present in the UK, it's a small gathering with wine and cheese, all the way up to level 5, when the risk of healthcare services being overwhelmed is matched by a Downing Street party level of a full-on rave. And I won't read out the rest.
I mean, honestly, it's not fit for air, some of this stuff. I mean, just the most tame one is level 3, booze snogging, Gov in charge of refreshments. The idea that this is a highly political tweet from Ryanair, one of the biggest airlines
Clearly
in
unhappy.
the region. Not happy.
Level 4, the Prime Minister asking Thatcher's portrait if she comes here often. I mean, the person who sent this to us is Marcus Ashworth, Bloomberg opinion columnist, and he joins us right now. Marcus, there's some pushback in the UK and beyond. Businesses pushing back against the rules for the Prime Minister and his party and the rules for the rest of the country.
There is, but I think it's been overblown. And actually, if you look at the price of the pound, it's holding up really well, despite the fact that they're probably not going to get a rate hike from the Bank of England. There is some good news if you look amongst the morass of welter of bad news coming out at all angles. You look at some of the ferry data, DFDS are saying, in actual fact, they had a much better November. So amongst it all, I think the growth in the UK is actually doing pretty well. However, I think it's still, with Omicron and a number of other different things, we've got CPI on Wednesday, right before the Bank of England the day after. That's likely to dally with that 5% level. We're worried about 7% in the US, but the UK probably gets up to 4.8, 4.9, the CPI may be worse. That, could do something with the Bank of England, but probably they're going to do nothing. And wait till February with their quarterly review. The chances are they may do nothing then as well. So that's why we're seeing things getting priced out on the interest rate market for sure.
Marcus, there has been some shakiness within, well, the real estate market, maybe a healthy dose of shakiness because prices have just been going ever upwards. But is that going to be some sort of concern, do you think?
No, no. There's only one way for house prices in this country to go. It's up. Keep on going up. They're going to relax the mortgage rules, which means that, at last, people who've got very small deposits can actually access a mortgage, which we've had problems with in this country for the last sort of 5 years, certainly 7 years. So, unfortunately, with interest rates, staying very low, and such competitiveness in the banks, they really want to lend nice, safe mortgages. I think that only one place for house prices in this country with this ridiculous planning rules, small country, no supply, house prices keep on going up. So no one was there. You might think the Bank of England might think about doing something about it, but actual fact, they did that over the worst part of the pandemic. They've now had to relax those rules. Again, more pressure on lending more money to mortgages, which probably means house prices keep on going up.
Marcus, you've been in this market for a long time. You talk with a lot of traders in the bond market. How much credibility has the Bank of England lost over the past couple of weeks?
All of it. And I think there will be, you just have to look at some of the shocking numbers out of hedge funds. Let's not cry for hedge funds, but they're not supposed to lose quite so much money in spectacular way. And the fact that the Bank of England caused such dislocation across the world in US money market rates, European money markets, let alone the UK, I think it's a really, really bad handling. I think they keep on making it worse. And you know what would be perfect, just to confirm that how tone deaf they are, if they do raise rates on Thursday, because that would be the icing on the cake.
We've seen this kind of thing before, haven't we, Marcus? I remember back in 2014, that Mansion House speech from Governor Carney at the time, seemingly teeing us up for a rate hike. He never delivered it. Saw a big mistake over at the ECB when they teed us up for everything and didn't quite deliver everything. Seen that in the past too. Marcus, was this that much worse?
It was, because it was totally unnecessary. They literally changed for no reason and shocked everyone with a number of different series of statements, then backed them up, never backed away from it, and then failed to deliver, and then looked around and said, well, it wasn't us, we didn't tell you anything, when they both so blatantly did. So, to my mind, it was a very bad handling of a split committee. I do think there's a lot of the external members who don't want to hike rates are still upset about they were handled over potentially putting the rates negative. There's a split council there, and I think that Bailey, unfortunately, is not handling it very well.
Marcus Ashworth, thank you, sir. I talked to you about football briefly, but I know you're a rugby fan. You don't follow football at all. Marcus Ashworth, thank you, sir. Out of London. I know, I'm not coming to you on it. Champions League. UEFA having a tough morning. The Champions League draw needs to be redone. In a UEFA statement following a technical problem with the software of an external service provider that instructs the officials as to which teams are eligible to play each other, a material error occurred in the draw for the UEFA Champions League round of 16. This was a knockout stage. Manchester United were drawn against Paris Saint-Germain, which is a really tough draw for Man United. And I imagine Man United fans right now will be happy because the draw will be completely redone at 3 p.m. European time. Not a good weekend for people who have to organise sport. I'm thinking not just of the Champions League, Caroline, I'm thinking of Formula One as well for a certain Lewis Hamilton.
There's a few broken hearts. There was a lot of shouting going on in my family at that particular moment, and what a dramatic race. Amazing, really. But I know. You like Schumacher, so I know, you know, what is
I'm
it,
a
8
Hamilton
years
fan.
preserved for him?
I'm a bigger Schumacher fan, so I was conflicted, let's say, Caroline, to be diplomatic about the weekend. But I did lose my voice too, screaming at the TV yesterday morning. Can you imagine my neighbour yesterday at about 9 a.m. in the morning, thinking, what sport is on at this time? It was Formula One.
So what happens is that we create some icons, we call them tags, and they have a signal within them.
And when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command for whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, I don't know, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
Happy holidays from all of us at Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
For breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
We're seeing more and more of the Fed members becoming a bit more worried, right, about inflation.
The game, of course, is to stop a wage spiral from starting.
People are not well positioned for the environment that we're envisioning now.
There's a risk that all markets go down, both long-term treasuries, equities. There's really no place to run, nowhere to hide.
What people forget is negative real yields are a very, very positive thing for risk assets.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A massive week ahead from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow, together this morning with Caroline Hyde. Your equity market at all-time highs on the S&P 500. The Fed decides, Lisa, this Wednesday.
The expectation is for an acceleration in the bond taper, in the number of bonds that they purchase each month. People really thinking that perhaps they're going to go further and talk about the roll-off of the balance sheet. That could be the main upset to markets. Other than that, everything else is pretty much baked in.
What a difference a meeting makes. Lisa, the last meeting they announced tapering, and in between somehow they've woken up to inflation not being transitory, and we need to accelerate the whole thing. That's happened pretty quickly.
There's been a change in rhetoric at Fed Chair Jay Powell, and we were talking a couple weeks ago about whether this had to do with his reconfirmation or the idea that he was renominated to the seat, if that gave him actually more conviction. The data has changed, though, and I think that that is the issue, and you've seen the rhetoric change among the members of the Federal Reserve, and we will continue to see that. How far will they go? Will they go too far? That's
the pandemic has changed, too. Lisa, the pandemic has changed as well, and that's what maybe surprised people with that shift from Chairman Powell. At the same time, we had this uncertainty around Omicron. This coming out of China, the Global Times reporting, Caroline, that China has reported its first mainland Omicron variant case. That news out just moments ago.
But an hour ago, the UK saying that at least one person has died here from Omicron, and the spread is going to mean that it is the most pervasive here in London. That Omicron narrative is going to affect the Federal Reserve in questioning, I'm sure, but it's certainly already affecting the Bank of England that we've talked about already, their central bank policy meeting on Thursday, and a hawkish pivot. They now wait more patiently, worried about the economic ramifications and the fact that it's in China. This is worldwide. The impact, though, is still to be borne out on the economy.
Typically, if I saw a headline like that in the UK or the United States, Lisa, I might not even read it out because it's obvious that that variant would be in the US, would be in the UK, and we'll work our way from there. For China, as you know, the tolerance for COVID cases is so low that a single case, a handful of cases, matters so much more to policymakers over there.
In other words, zero COVID policies lead to potential shutdowns of warehouses, of shipping lines. How much does this disrupt supply chains further? And how much pressure are they going to feel to try to remove some of the zero COVID policies? How much is this doing really being done ahead of the Olympics versus something more sustainable?
Yeah, this came from Citi over the weekend. Continued supply chain issues and an ever tighter labour market present upside risk to both goods and service prices in the coming months and beyond. The beyond piece of this, Lisa, just the idea that this is going to stick with us for months and months and maybe more quarters as well.
I was struck by a story last week about supply chain disruptions and the ships off the port of LA and how there's been anecdotal data that it's getting better. But if you look a little bit further outside of the lens, you see that there are all these ships, these tankers outside of view, waiting further out so that they can't be surveilled in the same kind of way, and that supply chain issues are not getting materially better.
Are you suggesting they're massaging some of the numbers?
I'm just
maybe, Lisa,
saying that things are, out there.
Okay.
Would you say that it's massaging the numbers?
No, I'm just asking. I hadn't seen the story, so I'm asking.
It's fascinating. Well, a lot of people think that a lot of the idea that there is a sort of easing in the supply chain disruptions is a facade and can easily be disrupted by a number of developments.
We'll get Wei Li's view on this of BlackRock in just a moment. I want to check in on the price action for you. Record highs at a close on Friday. Biggest week of gains of the year so far, back to February. Biggest week of gains back to February on the S&P. A record high on the S&P 500 yields in a couple of basis points on 10s to 146.33 on 10s right now. Crude negative about 50 cents. We're down 6 or 7 tenths of 1% to 71.19. Joining us now is Wei Li, Global Chief Investment Strategist at BlackRock. Wei Li, I wanted to start with China and then we'll work our way back to the United States. But can you give me your read on the Chinese economy following a week where people really started to reset their expectations for a policy shift from the Chinese Communist Party? What's your view on that?
Well, what we have seen so far this year is that there is this greater pivot towards social objectives and common prosperity, and that was evidenced in the regulatory clampdown earlier in the year. But what we have also seen this year is that growth is deteriorating from quarter to quarter, from above 17% in Q1 to now below 5% in Q3, and Q4 is looking even worse in terms of the growth levels. And as a result of the deteriorating growth trajectory, we have been of the view that support will have to ramp up heading into a significant year that is 2022, characterized by the Winter Olympics, characterized by the Party Congress. And sure enough, we have seen support actually did come through in the form of triple R cut, in the form of greater fiscal spending expectations. And we continue to think that will be the case as we head into next year, which is why we are modestly constructive on China assets, both on the equity side as well as on fixed income side, CGB.
Wait, you are not alone in this. A lot of people have said that there needs to be more accommodation in China because of some of these issues. And yet over the weekend, the Politburo of China came out with rhetoric that was new around the housing market, talking about bringing down pricing because this is a place that people live, not just invest in. How much is there sort of a talking out of both sides of the mouth and frankly, a harder line in maintaining the deleveraging stance from the Politburo over the past few weeks?
It's a fine balance, isn't it? It's always a dance between this longer term journey of quality revolution, thinking about deleveraging, and balancing that with the near term support. So indeed, we have seen kind of rhetoric pointing to wanting to delever in the private sector, in the housing market, and also thinking about the resolution of how is it going to look like for Evergrande. But in order to make sure that, in order to contain the spillover effect from deleveraging activities, growth side needs to be shored up even more, which is why we see easing policy coming through to make sure that the what is happening in the housing market is properly contained within the housing market and does not lead to a broader spillover on the economic more broadly and leading to a broader risk off, which is not what we expect heading into next year.
Good morning, Whaley. I mean, it's great to get your perspective from China moving out to its worldwide impact, of course, as China tries to give some support to its own economy and the equity markets reacted off that earlier. What about the supply chain issues? As Jonathan was just mentioning, we get that first case of Omicron coming into China. Are you worried at any point of the inflationary pressure that we might see once again if indeed the new variant hits China, hits supply chains, hits us in Europe and in the US?
You are absolutely right in that the zero tolerance policy in China does mean that Omicron cases popping up in China will have even more kind of significant impact on the supply side, on the economic activity side, which is why we expect on the policy side things will have to come through even more, because they would have to kind of shut down on the economic side even more in comparison with their developed market counterparts. Now, in terms of the spillover more broadly and thinking about a kind of policy room, we do see on the inflation side not too elevated in the case of China. PPI is high, but CPI is still reasonably contained, and that actually does give them room to ease a bit more if needs be. And if you think about versus last year, developed world has really kind of come through with policy revolution, coordination of monetary side as well as the fiscal side. China has been rather reserved in their policy response, leaving them greater room to act. So that is why our case in China is modestly constructive against the broader backdrop of a very, very low starting allocation to China in global portfolios. But more broadly, thinking about 2022, we talked about supply side constraint. We do expect that kind of getting alleviated somewhat second half of next year, and the combination of still robust growth dynamics as well as the negative real rate environment should continue to support equities, and within equities we prefer developed market equities over emerging market equities.
Whaley, within DM, is there an international bias to that asset allocation, that equity allocation away from the United States, or is it towards the US?
It's interesting that you should mention that. So our DM equity core has gone through a bit of a journey in 2021. The first half of 2021, we preferred US equities because the restart was way ahead in the US. But at a mid-year point, we pivoted from US to European equities as the baton of growth peak acceleration shifted from the US to Europe. And sure enough, this differentiated approach to play the uneven pace of restart was also reflected in the fact that the difference in earnings, materialized earnings growth in Europe and in the US, the difference is so far this year almost 15%. But now looking ahead to 2021, the uneven pace of restart is washing through a little bit. And if you look at kind of the earnings expectation difference across US, Europe, Japan, they're not that different, ranging from 12% to 15%. So we're less kind of playing the theme of uneven restart, and instead we see actually what I just talked about, this combination of negative real rate and dynamic kind of growth environment supporting DM equities across the board. We're modestly constructive across DM equities, but under that we also want to kind of think about barbelling across cyclical sectors as well as secular growers like technology and healthcare.
Whaley, always smart. Whaley of BlackRock. On Europe, the international story, China too, against the United States. Lisa, Europe right now up almost 20% year to date on a stock 600, the S&P 500 up 25.45% year to date.
The most fascinating call heading into next year, I think, is overweight Europe. We've heard this from some people saying that Europe is going to be on hold from a policy standpoint. The U.S. is going to be hawkish. How this plays out will be pro-Europe.
We'll get the policy view on the fiscal side from Isaac Boltanski, the Director of Policy Research at BTIG. That conversation is just around a corner. We have a record high to start the week on the S&P 500, going into a Fed decision just 2 days away. From New York City, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Boris Johnson is warning that the UK faces a tidal wave of Omicron infections. In an address to the nation last night, the Prime Minister set a deadline for the end of the year for the country's booster vaccination programme. The number of new Omicron cases here in the UK almost doubled on Sunday from a day earlier. In Europe, natural gas futures rose to the highest level since October. There's increasing concern that Russia's Nord Stream 2 pipeline won't operate this winter. Approvals for Nord Stream may take up to 8 months. Plus, the West is hardening its stance against Russia because of increasing tensions over Ukraine. In Kentucky, the death toll from the tornadoes on Friday may be less than originally feared. Still, at least 50 people are believed to have been killed. Kentucky's governor says more than 1,000 homes were destroyed. The storms killed at least 14 people in 4 other states in the South and Midwest. In a Paris court today, it was a victory, well, of sorts for UBS. The Swiss bank was ordered to pay a heavily reduced $2 billion penalty for helping wealthy French clients stash undeclared funds in Swiss accounts. The original penalty had been a record $5.3 billion. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The characterization of inflation as transitory is probably the worst inflation call in the history of the Federal Reserve. And it results in a high probability of a policy mistake.
Mohammed El-Arian there of Queen's College, Cambridge. He said that line a few times now, Lisa. I think we should clarify that line, though. The worst inflation call in the history of the Federal Reserve. Not necessarily the worst call of the Federal Reserve. I think some people might look back to subprime is contained. I think Luke Carr of UBS and on Twitter this morning talking about that one, Lisa.
That might be considered the worst call ever. Honestly, Mohammed El-Arian has been ahead of the curve, and he's been talking for weeks on your show in columns about how concerned he is about the Fed not moving quickly enough. What's interesting is people are catching up to him, right? He is actually...
It's consensus now.
Yeah, and this has become the consensus, and he was ahead of the curve, and he's basically beating the same drum that he's been beating all along.
You know what's got lost, though, in between all of this? The call that Larry Summers and Mohammed made months and months ago was actually a two-part call. The first part was that we'd get a lot of inflation, it would not be transitory. The second part is that it would overwhelm the policy effort down in Washington, D.C. And that policy effort right now is the Build Back Better plan. And what also gets lost is that when you listen to Larry Summers and you listen to Mohammed, they support a lot of the stuff that's in that bill. But obviously the inflation numbers are getting spun in D.C. another way.
There's a difference between sending checks out to every American household and building bridges, building roads, investing in education. They're different things, and they're trying to distinguish that as we see the inflationary reads come in at the hottest pace in decades.
With Lisa Brabbett, I'm Jonathan Ferro, joined today by Caroline Hyde. Tom Keene back with us tomorrow. I want to talk a little bit about this fiscal effort and bring in Isaac Boltanski, Policy Research Director at BTIG. Isaac, your call, sir. We remain bullish on the prospects of the package being signed into law. What's shaping that view right now, Isaac?
Sure. Look, there's an overarching reality in D.C., which is things appear impossible right up until the point that they are inevitable. And I think that that's where we are right now with this Build Back Better package. I think it's going to be an incredibly busy week. We're waiting for the outcome from what's known as the bird bath, which is a procedural effort in the Senate. We're also going to wait for a pretty big meeting between the two most important Joes in D.C., Joe Biden and Joe Manchin. But ultimately, my call, and I think our view here is they will narrow the bid and ask between Senator Manchin and Senator Schumer and the rest of the Democrats over the next few weeks. And we're going to get to a lower number, something closer to 1.3 to 1.5 trillion, rather than the 1.75 that cleared the House a few weeks ago.
Isaac, is it really a headline number still, or are we now talking about the SALT cap deductions, on capital gains taxes, on things that are very specific and that are policy objectives for different politicians on opposite sides?
Yeah, look, I think that given the inflation prints that we've seen, given what we're expected to see from the Fed on Wednesday, I do think that Senator Manchin is going to ask for the headline number to come down a tiny bit. But you're right. Right now, we are arguing over a few specific issues. SALT is one of the biggest, the state and local tax deduction, as you know. But there are also some ongoing fights regarding clean energy tax credits, the electric vehicle tax credit, which now has international dynamics, and some of the prescription drug changes as well. So my sense of all of this is when you're arguing about specific issues like we are right now, you're very close to the goal line. And look, I personally think that they're not going to make their Christmas deadline, that this is going to bleed into January. But I'm still very optimistic that they're able to get a $1.3 to $1.5 trillion package done in early January.
So this morning, Jared Bernstein, the economic advisor to President Biden, had a tweet storm about inflation and the Build Back Better plan, basically trying to push back against people who say it's inflationary. He talks about the fiscal drag, how this could potentially counteract that, and he talks about the stimulative aspects of this. How much is that line of thought gaining traction in a Washington obsessed with the inflation reads that will affect their re-election chances in 2022?
Look, for most of the politicians in D.C., data is a Rorschach test, right? You can sort of pick and choose your own data points. I think the White House is going to say, and this is accurate, that the bill as structured pays for itself, and the investments are over a 10-year budget window. Some of them actually sunset even earlier than 10 years. And so that's what the White House is going to push. And I think that is going to gain traction because it is factual. Republicans, on the other hand, are going to push back and say, if we actually extend all of these programs beyond their scheduled sunsets, it would actually cost $3 trillion. And so my sense, Lisa, from this is that everyone's going to be able to, choose their own adventure with their talking points. But ultimately, Democrats will coalesce and get something done because this isn't as inflationary, as structured, as the American Recovery Plan, that $2 trillion package that passed earlier this year.
Isaac, Caroline in London, good morning to you. I'm interested in how much you feel that the administration will try to get a grip in and of itself of inflation, whether it does more within the oil prices already been very much focused upon, whether they're going to try and control the narrative, or whether they're really going to defer to the Federal Reserve, as indeed you've written a lot about when Jay Powell is going to be renominated, and indeed Lael Brainard, that was your base case, and really that it's to them that the administration looks to try and take the heat away from inflation.
I think that the White House is going to continue to drive headlines. I think there's going to be a lot of focus on supply chains, and I think we're going to continue to see some of these investigations in supply chains continue as well. But there really isn't that much that I think the White House will alter in its actual policy. They renominated Jay Powell for a reason. I think in the next few days, they're going to nominate 3 new governors to the Federal Reserve board. I think those picks are going to skew towards the progressive and or dovish side of the ideological spectrum. And I think that ultimately there's a hope and a belief within the White House that the supply chain issues being resolved over the medium term are going to help with the pricing pressure.
Isaac, always good to hear from you, sir. Isaac Boltanski of BTIG on the road ahead. A constructive road ahead for Isaac on the Build Back Better effort. On the inflation number at 6.8% on Friday, Lisa, the spin down in D.C. in full swing now. A tweet storm on Twitter that I know you've been following as well. Give me the insight into that and just the effort to convince people that this bill's not inflationary.
They're talking about, first of all, the idea that there's a fiscal drag, that basically some of the fiscal spending is going to roll off and not be included in the amounts in the coming years, and that's going to have a negative effect on the overall growth picture. They also talk about how some of this will be stimulative in the economy, and that's not being featured. And yet, at the same time, really what this comes down to is a distinguishing between this and the emergency effort earlier in the year to try to send checks to all of the Americans. They're saying it is different, and a lot of people agree, but it's a hard needle to thread, given the fact that we're seeing inflationary prints at the highest levels going back to the early 1980s.
Just distracted by a call from John Stolfus over at Oppenheimer. Lou Wang pointing this one out. Now the most bullish on the street, Lisa, 53.30. We do not expect the Fed to slam on the brakes to choke off liquidity, but rather look for the central bank to pump the brakes as lightly as it can.
This is a lot of the bearish case for a lot of people's portfolios. Steepening yield curve.
53.30 though.
Yeah, I mean, look, this is the whole thing. There is no alternative. Doesn't change if you have a Federal Reserve that has the same kind of ethos as it's had in the past few years.
The reason I keep repeating 53.30 because it's just 30 points higher than BMO. I think someone's going, no, okay. From New York City this morning, good morning. This is Bloomberg.
antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City for our audience worldwide with Lisa Abramowitz and the brilliant Caroline Hyde. I'm Jonathan Ferro. Your equity market up 10 on the S&P, advancing 0.2%, all-time highs into Monday after Friday's close. The biggest week of gains going back to February. Yields coming in a couple of basis points on 10s to 146.67. The Fed decision just a couple of days away. I keep calling it crystal ball season because that's what it is, Lisa. Deutsche Bank's Binky Charter coming out with 52.50 for his year-end call on the S&P. I talked about that a little bit earlier in the program, but we have a new bull on the street. The biggest bull is now John Stolfus at Oppenheimer Asset Management. Previously, it was BMO at 5,300. John going to 53.30 on the S&P year-end next year. And for anyone sitting here saying, oh, that sounds crazy, that's too bullish. Lisa, we played that game 12 months ago, didn't we? And I think the high 12 months ago, the high forecast, the year-end call, I think it was about 4,400 on the S&P at the time, and we are well north of that now.
The biggest downside risk over the past 18 months or so has been not being bullish enough. And honestly, Tom Keene reminds us of that every day as he looks at his triple leverage all cash fund.
Very upset as well, with tears.
Tears.
Running down his cheeks every
Tears
time.
Of Tang.
Tears of Tang. Tears of Tang.
It's a band.
Tears of Tang is a band. It sounds like a band. Futures up 2/10 on the S&P. We can talk about an inflation call as well. Stephen Stanley, Chief Economist at Amherst Pierpont. Stephen Stanley, you've got things to say, sir. It is astounding that the Fed is still easing, adding further accommodation, even as inflation is at a 39-year high. Stephen, how are they going to change this?
Well, they're working. I mean, they're starting to accelerate the pace of tapering. It looks like they're going to be done with tapering by March now. We'll get that announcement hopefully later this week, and that does clear the decks for rate hikes beginning as early as next spring. But you know, let's not get too distracted from the main story here, which is that the Fed is well behind the curve, and even with this step that they're likely to take this week, you know, they're going to remain well behind the curve, and if anything, they may have fallen further behind over the last several months.
Well, work with me on this equity call that comes from Oppenheimer then. They're looking for 53.30 on the S&P year-end next year, and they say they don't expect the Fed to slam the brakes. They expect the central bank to pump the brakes as likely as they can. Is that in line with your thinking, Stephen? Do they have that option to go slow, to go lightly?
That's still my baseline case. I mean, I think the fact that they believe that neutral is quite low means that they don't have as far to go, and that reduces the urgency to some degree. You know, the consensus view is that the Fed's going to tighten 2, maybe 3 times next year, and that's still going to leave the funds rate below 1%, which is still extremely accommodative. So you can see why that's still probably a pretty favorable atmosphere for risk assets. But certainly, you know, the liquidity, the immense liquidity that's in the system, we're going to stop adding to it soon, and the Fed is going to start to raise rates next year. So, you know, we'll have to see how that all goes. You know, I think it's a tenuous time period, I think, for risk assets. But the real risk, as you alluded to, is that the Fed at some point concludes that they've fallen so far behind the curve that they have to really rush to get rates up. And that's a scenario that we really haven't seen certainly since 1994.
You know, I love this, Stephen. I have so much respect for you. I also have so much respect for Mike Collins of PGIM Fixed Income, who has the exact opposite call, that not only is the Fed not way behind the curve, but needs to be probably more patient than the market is currently pricing in. If you were having a conversation with him, what would you point out that edifies your view and not his?
Well, the obvious thing would be inflation. And I think we've gone very rapidly within less than 6 months from a case where inflation was high, but it was high for a bunch of special reasons, you know, reopening from the pandemic, and it was just really a handful of categories. And now suddenly you look at the CPI over the last 2 months, and the inflation pressure is very broad-based. You look at other sources of information, firms have a great degree of pricing power. There's a lot of talk about more price increases in 2022. So the idea that this was just a flash in the pan, I think has gone by the wayside. And I would also point to the labor markets. I think the labor market is quite tight, and I wouldn't be surprised if we, you know, hit full employment within the next, call it 3 to 6 months. So I just think the economic situation is such that, you know, the economy's been overheating for most of this year. And as long as the Fed remains easy, that's not likely to change.
How much is housing a part of this? This is something Bill Ackman pointed to as an aberration in the CPI basket, given the month-over-month, year-over-year comparisons we're seeing anecdotally from rental home companies.
Well, in the CPI, rent and owner's equivalent rent, so we'll call it shelter costs, combined represent about 40% of the core. The much smaller percentage in the PCE deflator, but still the biggest piece of inflation. And what we know from research out of different Fed banks is that those numbers tend to lag the home price appreciation numbers by, you know, 1 to 2 years. And so we're just starting now, just within the last, call it 3 months, to see the acceleration in those categories of the CPI, and there's much more to come. It could get worse, and I think that's one of the key things that developments that we've seen over the last few months that point us toward a more broad-based and troublesome array for inflation.
And we're going to be speaking much more about real estate with Jonathan Miller in a moment, Stephen. I'm interested in the longer term, potentially dovishness of the Federal Reserve. In the here and the now, you're questioning why they're not tackling inflation head on. Longer term, where's the terminal rate for you?
So the Fed thinks that neutral is 2.5. I think it might be a little higher. I think they're going to have to go beyond neutral in this cycle, given how far they've let inflation run already. So my thought is, you know, we're probably going to be somewhere in the 3 to 3.5 range by the time we end. And that's a very out of consensus call. Wow. If you look at what the markets are pricing right now, the markets don't think the Fed ever gets to 2%. So the markets are saying...
Is that a steady pace for you, Stephen? Is that, you know, just rate hike after rate hike, or they have to, like, amplify it at the start and then start to tail off? How does that look to get to 3.5?
Right. My baseline is still just very steady, you know, once a quarter, 4 times a year until we get to whatever level we need to get to. I think as we talked about before, the risk scenario, in my view, is that the Fed ends up having to scramble and move more rapidly, whether that means moving at every meeting or even at some point a move that's larger than 25 basis points. And again, that's a scenario that, you know, most people that work in the financial markets have probably never seen, because it's we haven't seen that since the 90s.
When does the balance sheet come into play in terms of allowing it to roll off?
Right. So let's say they're going to end asset purchases in March. The way they handled this last time was they wanted to make sure they were safely away from the zero bound. I think that's probably less of a concern today, but still, you know, they're probably not gonna allow the balance sheet to run off until they've gotten a few rate hikes under their belt. For me, that's a 2023 story, and once it happens, it'll be slow. They actually last time around, they kind of overshot in their view a little bit and allowed the balance sheet to shrink too much. So I think they're going to be careful about that, and they think they can handle, I think, a large balance sheet without allowing that to have undue influence on the economy. So my guess is they're not going to be in a huge hurry to get the balance sheet down, but that's something that I view as starting in 2023.
You're, of course, a man focused on the United States, won awards for it, Forecaster of the Month plenty of times. You're a man who used to work at RBS as the chief US economist as well. But paint the global impact to this for us a minute, Stephen, because what happens to the other central banks? Some which have tried to turn hawkish and then have backed off, like the Bank of England. Others, where in the emerging markets, they've had to go hawkish a lot earlier. Where do you see the ripple effects?
Right. Well, look, inflation seems to be pretty much a global phenomenon. It's higher in some places and lower in others, but you know, I think it's accelerated in most places. So I do think we're going to see a lot of normalization of policy in 2022. As you say, kind of different central banks on different time schedules. It seems like the Bank of England might be even a little bit ahead of the Fed, even though expectations for rate hikes there backed off a little bit, and with obviously with the Omicron outbreak, you know, pushing things off this week for sure. The ECB and the BOJ much further behind. I think their economies are not in a position for them to be tightening just yet. So, and then the emerging markets, you know, I think, as you say, they definitely do, in general, need to react to the Fed. So, you know, that's a scenario that as the Fed starts to raise rates next year, I suspect that you're gonna have to see a lot of banks around the world who kind of follow suit to try to keep up with the Fed.
Are you taking the rest of the year off after Wednesday, Steve?
I never get a day off. No, I'm going to take a little bit of time off around Christmas, but okay. We'll be getting those year-end pieces out and keeping everybody up to date on what's going on.
I'm just lobbying management, looking for some support, Steve. So
appreciate that, John. I'm glad you have my back.
I'm trying to do the same thing for you, sir. Stephen Stanley there of Amherst Pierpont. Thank you very much. You've got to have these people's back, Lisa. You know, they work really hard, and after Wednesday, that should be it for the year. This came from the Financial News in the UK. Goldman rolling back its return to office program in the UK, according to the Financial News, signing a person familiar with the matter. We saw some of this last week, Lisa. That's the direction of travel right now.
Yeah, JP Morgan and others saying the same thing, and this comes after a directive from Boris Johnson, one of the many discussions he's been having, that people should work from home if they have to. Are we starting this all over again? And you do wonder what the ripple through effects will be on all of the businesses in the heart of the city that were trying to reopen and now are going to get crushed.
Give us a flavour of that now, Caroline. Just how quiet, how sleepy is it in the City of London at the moment?
Well, you walk in and our office is quieter outside of television. Anecdotal evidence abound just right here, right now. Of course, people are worried. It's certainly going to be quieter. I spoke to a cabbie on the weekend, a guy who drives a black cab, already saying it's a lot quieter than he anticipated. He's so disappointed. The restaurants are feeling it too. People are just slowly but surely cancelling their plans as they headed towards the holiday. They want to be together with their family, and you've got to do prioritisation for that.
It has been a tough time for the cabbies in London and beyond, and it's getting hard again. Almost 2 years of this, Lisa, almost 2 years of it.
Look, I'm ready for this year to be over too. You can lobby me all you want. I want it to be over too. I'm just saying that there could be other things that happen.
True. No, I'm not ruling that out. That's why, you know, to clarify, it's the final week of the year with a big scheduled event on it. Okay.
Yeah. But that said, it's been exhausting. Let's end this stuff.
PIMCO's Jerome Schneider is going to be joining us shortly as we count you down to a Fed decision from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The UK's health minister says once again the country is in a race between the vaccine and the virus. Sajid Javid has detailed plans to offer all adults in England a booster vaccination by the end of December. Javid also said there is no certainty the government will be able to keep schools open. In Kentucky, they are still searching for victims of the tornado that has left a 200-mile path of destruction. Governor Andy Beshear has lowered the death toll. Still, he says that at least 50 people have died. In Edwardsville, Illinois, 6 people were killed when a tornado slammed into an Amazon delivery depot. 45 people made it out alive. Senate Majority Leader Chuck Schumer insists the Senate will pass President Biden's nearly $2 trillion tax and spending package before Christmas. But time is running out, and Democratic moderates still aren't on board with draft proposals. A delay into the new year could hurt momentum for the Democrats, who need a victory as they prepare for the 2022 elections. Apple is inching closer to a $3 trillion stock market value for the first time. Shares are higher in pre-market trading. Apple is up more than 200% since the coronavirus first sent the world into lockdown last year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
An extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the president's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops, tanks, guns, UAVs. Clearly, neither side are taking any chances.
surveillance, the Fed decides. What's the Fed's forecast? Will they speed up tapering? Will we see earlier rate hikes? Tune in Wednesday starting at 1:30 Eastern on Bloomberg.
We've got to make sure that not only are we safe, but people feel safe. There's no question. Both are important. But look around this city right now. This city is thriving. We've come back strong from COVID. And the bottom line is that there is, today in New York City, a much safer city than we were 8 years ago. There's no question about that.
That was the mayor of New York City, Bill de Blasio, as he tries to revive faith in a city very much battered by the pandemic. And we have seen that city rebound in a massive way. If you look at the real estate market, at least in certain places. I'm Lisa Abramowitz, Caroline Hyde in London joining us, and Jonathan Miller, President and Chief Executive Officer of Miller Samuel. We are so lucky to have him join us after putting out a fascinating report highlighting this record surge in rents in Manhattan, but it isn't for everyone. And I want you to start talking about how, in some ways, in your words, the divergence between high-end apartments and low-end apartments is the widest that you have ever seen.
Yes, when we look at the rental market, we're really looking at a polarized market. If you look at the upper half of the market, that's the narrative with bidding wars, apartments, people waiting, 75 deep to rent an apartment, and that's half of the market. That skews higher. We're looking at rents that are higher than pre-pandemic levels by a few percent. And we're also looking at year-over-year record growth, almost 23% in rents. If we look at the other half of the market, skewing to the lower half, we're lower wage earners. We're looking at rents that are about 11% behind pre-pandemic levels, even though they've been rising for the last couple of months, up about 10% year over year. So there's a tremendous polarization. I've been covering the market for almost 30 years, and I haven't experienced this type of differential in performance. And I think it largely has to do with post-lockdown, economic damage that was skewed towards lower wage earners versus mid and upper tier salary types didn't see anywhere near the damage.
And this is something that I'm sure is being seen around the world. The United Kingdom returning to work from home, Goldman Sachs among those banks telling people, you know what, just stay there. It's going to be a little bit rocky over the next few weeks. What do you make of the fact that you're seeing a return to the city in the United States, into New York City, despite the fact that you're not seeing the same sort of robust return to offices that so many people were expecting?
Yeah, I think if we were having this conversation last spring, we'd be saying, wow, September, October, that's when the light switch gets turned back on and everybody's going to go back to the office. The Delta variant over the summer really kicked the can down the road, and what we end up seeing is a very slight return in office workers. In fact, in Manhattan, it's about 35% of the office towers have occupancy and 2/3 are empty. And that has ramifications like not breathing oxygen into street level retail, which is one of the things you notice. The sidewalks are very full, anecdotally, but the retail is very empty. And I think that's going to be, that's going to play out over the next couple of years.
And certainly escalate in the next couple of weeks and months as Omicron starts to take its hold as well. I'm interested, of course, you serve on the New York City Mayor's Economic Advisory Panel, and we're just hearing from the New York City Mayor outgoing a moment ago. Talk to us about the push forward, therefore. If the lower rental market hasn't seen the sort of uplift because of the longer-term economic damage done to those of lower income, now we start to see wage increases to a certain extent. Do you think that will come back in New York City, or is there an issue that those sorts of jobs aren't going to want to return to a city like New York City? Those workers will go elsewhere.
Well, I think it's a combination of both. I don't think even with higher wages, I don't think we'll return to business as usual. I think there's been a fundamental structural change in basically due to the ability to remote work. And I think right now, the market, there's not a clear direction on that. So I think this is going to be a multi-year discovery process as opposed to some sort of, as I said before, like a light switch flipping on and all of a sudden everything's almost normal. I really think there's a long process of discovery here. It is encouraging, however, to see record sales volume in real estate and quick rebound in rental prices, which indicates or suggests that at least the consumer is thinking that things will normalize over the next few years.
And what are they wanting, Jonathan? Are they still, at one point it was you could not get any outside space within New York City for love nor money. Is that still what everyone's wanting, or are people sort of putting that initial real emotional damage of COVID to sort of one side and wanting apartments where they live in the city and then they have places on the weekend?
So I think the latter. I think, I think there was sort of, the initial panic and people wanted more space. But really, if you break out the numbers in terms of the skew towards larger space, it really is a function of what I was talking about before. The higher end was saw more strength, and that inherently is larger property sizes. So we're looking at the average size of properties skewing larger in terms of what's selling. But I think that's a bigger part of that is just that more affluent people that are more affluent or who are more active in the market.
Before we let you go, Jonathan, we've been talking all morning about the SALT tax deduction, the SALT and state and local tax deduction, which really matters for New York City real estate. How much has this been a factor in people's purchasing versus renting, or just in discussions in general for potential homeowners?
Well, the SALT tax, because it came into effect January 1st of 2018, the market had about 2 years to actually price it. So we're really looking at a housing market that dropped in value about 14 to 15%. So I think if there is a modification of that existing SALT tax, I think you're going to see a jump in prices as a result, because, as I said, it's already been impacted. It's been priced into housing prices already.
Jonathan Miller of Miller Samuel, thank you so much for being with us on this pivotal moment, this discovery process, as you say. And it's a discovery process in markets that are at all-time highs in the United States. Over in the United Kingdom, I've got to say, Caroline Hyde, I'm so glad you're here. Looking at natural gas prices in the UK, absolutely on a tear today. Do people still talk about this in the streets, at family dinners? Is this still a huge issue and a point of concern?
Dare I say it, if we're able to gather around a Christmas table, will it be gas prices and crypto that dominates the conversation? I mean, it's having its ramification. It comes across, of course, the increased tensions, Russia and Ukraine, people worrying about the safety of gas storage, the safety of supply coming into the colder winter months. But yeah, it still very much dominates. And from an inflation perspective, how much is that going to dominate conversation come Bank of England on Thursday, when we anticipate they're going to be less hawkish?
It's a great point, the concern about inflation still running hot at a time when there is a slowdown in the economy. Coming up, Jane Harman, Distinguished Fellow and President Emerita at the Wilson Center. That will be at 12 p.m. New York Eastern Time, getting a sense of the road ahead in Washington, D.C. From New York and London, this is Bloomberg Surveillance.
提前的就是步入工作岗位，然后对这个工作更加熟悉，然后调整好心态，就能够在赛时去一个更加自信、更加昂扬的一个姿态去迎接来自世界各地的代表团的外宾们。
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the Q3 was the quarter that was most affected.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It is Fed Decision Week from New York City for our audience worldwide. Good morning, good morning. Your equity market with a lift, up 7, advancing a little more than 0.1% at all-time highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. It's Fed Decision Week.
Powell, Jerome Powell,
Fed Chair Powell, the Fed meeting.
That's ultimately the story.
The Fed does need to tighten here.
Clearly, they are starting to act.
Maybe getting hawkish just when inflation's about to crash around their ears.
We're likely to see the Fed accelerate their tapering.
They've made it pretty clear that they are willing to accelerate the pace of taper.
Yes, the tapering is coming. It's more aggressive than expected.
I think what they're doing is really giving themselves the option to hike faster in 2022 should the data support that move.
This Fed has become a little bit more data dependent.
The Fed is really at an important transition point.
There's a very delicate balancing act.
It is a very delicate balancing act. We're going to have that conversation now with Nuveen's Tony Rodriguez and Emily Hill of Bowersock Capital Advisors. Jerome Schneider of PIMCO will be joining us a little bit later this hour. Emily, first to you. Let's just start with base case expectations for this Wednesday for this Fed. What are they?
Well, clearly the consensus is that the Fed will double the pace of tapering, which I think they have to do. Because at this point, the market is concerned enough about inflation that I think it would actually alarm people if they made the decision not to do that. And these recent inflation numbers, 6.8%, highest since 1982, they do need to act. And I think it's clear that they need to at least open a path for hiking interest rates more quickly than they originally anticipated in 2022.
Tony, what's your view, sir?
Hey, good morning, Jonathan. Good to be with you. So we agree that they will very likely double the pace of the taper so they can conclude by March. We're also going to be looking at what the dot plot tells us. We obviously expect to see a significant increase in the number of tightenings that the dot plot reflects. Our base case right now would be that you'll probably see a movement to a 2-3-4 scenario, meaning 2 tightenings in the dot plot in 22, 3 in 23, and maybe as many as 4 in 24. Given that I think they're going to stick with their kind of terminal long-term equilibrium rate still being north of 2%, which we think is higher than we'll actually end up realizing.
So we've got to do a couple of things, haven't we? Work out how aggressive they might be or won't be in the coming years, and then work out what that will mean for this market. We have a new bull, biggest bull on Wall Street. It's John Stolfus over at Oppenheimer at 53.30 year-end next year. And here's the quote from John. "We do not expect the Fed to slam on the brakes, but rather we look for the central bank to pump the brakes as lightly as it can. Emily, I'd love your reaction to that. Do you think the Fed can pump the brakes as lightly as it can? And do you think we get anywhere close to 53.30 at the index level?
Well, they're clearly walking a very fine line here. And I think, one of the questions in my mind is when the Fed starts, basically when central banks around the world stop buying this volume or this amount of bonds on a monthly basis, who's going to buy them? And so, I think they have to tap on the brakes, but they need to do it very, very carefully. And I mean, the good news is that the stock market, at least historically, has tended to do well during a rate hike cycle. So if you look back through in 2016 to 2018, it was almost 2 years before the market flinched when the Fed was in the middle of a rate tightening cycle. So, I think they can do it without disrupting, this upward momentum, but it's going to be tricky.
How much of a sea change will we actually get? This from Morgan Stanley. I want to get as much research as I can into this hour. There's a lot coming out in the last couple of days. Does a sea change at the Fed mean a tsunami for the rest of the world? Markets have started to price in Fed hikes, but yields have moved nothing like they did in 2013. Real rates look likely to pick up only gradually. This time really does seem to be different. Tony, your view on that this is different to 2013. How so?
Definitely think it's different in 2013. First of all, you have a much stronger underlying economy, and of course, you're dealing with the pandemic, which creates an enormous amount of uncertainty with respect to economic activity. And then lastly, inflation is at significantly higher levels, given that we're at the highest rates in 40 years. So I think what the Fed is trying to do is basically buy some optionality. Right now, the market is pricing in a pretty hawkish scenario with as many as almost 3 tightenings next year. I think the Fed is comfortable there because then it allows them possibly some room to dovishly surprise as we move through next year. If, in fact, we see inflation begin to moderate in the second half, we expect inflation will moderate, but it will remain at levels well above the Fed's 2% target. So persistent inflation, but certainly declining from current levels. And that's why we'd be pricing in more of a 1 to 2 Fed tightenings in 22 rather than the 2.5 to 3 that's currently priced into the market.
Tony, I want you to build on that because what we've seen so far is this higher inflation conversation not translate into higher interest rates. Credit Suisse and Jonathan Golub said the following: inflation is not translating into higher rates. It's a huge benefit for equities. We can deal with the equity piece separately. But Tony, I want your view on that, some perspective, why this story of higher inflation is not translating into higher yields. We only have 60 to 70 at the front end on 2s and in and around 150, 145.98 right now on 10s.
Yeah, Jonathan, it's a great point. And I think the main reason is because there's still medium-term growth risks that the market is pricing in. So whether those come from the slowdown that will come from COVID remaining kind of a 22 story more than any of us would like, but also in addition to that, it's really the high levels of debt that have been incurred not only in the U.S. but globally to basically respond to COVID that eventually becomes a drag on global growth. The last piece of that puzzle is the story in China, where China clearly has too much debt. They have quite a bit of, right now, kind of tactics they're using to try to make sure that there aren't significant, a potential financial reckoning with respect to the levels of debt, particularly in the property sector. So that moderation in growth in China, coupled with high levels of debt globally, means that we think the medium-term growth prospects are actually back to the longer-term 2 to 2.5% growth type scenario. And in that world, it's difficult to see interest rates rise much above where we are today.
So, Emily, what would you say back to that? If we're going to have rates remaining low, that could be supportive for the equity market. At the same time, you've got Tony saying it's back towards trend, it's back towards the 2s. On inflation, maybe somewhere in the distant future, but on growth, maybe just around the corner. What would that mean for your capital allocation decisions, Emily?
I agree with Tony. I continue to believe that inflation will moderate to the 2 to 3% level. When that will happen, I think some of that depends on, what happens with COVID and this pandemic. I think we could end up with a pretty benign environment for equities. And I think that in part because, yes, the bond market is not overreacting to the inflation threat. We still have very significant amounts of liquidity in the markets. And, I think what we're going to see when we start the taper, as even if we expect interest rates to rise slightly, there's really nowhere else to put your money at this point. Cash and bonds are not going to achieve positive real returns over the next couple of years. So absent some major catalyst, I think we're going to see the market continue to drift higher. I do also agree with Tony that the big risk, one of the primary risks, is China. And, we have increasing global geopolitical risks in general. And I would put that one as the primary risk to keep our eye on.
I want to return to that as well, Emily, and to you, Tony, because it is so important, specifically from the supply chain perspective as well. Before we get there, I wanted to finish on this, Emily. Just your view on what's kept multiples elevated. I think the knee-jerk response to that question would be low interest rates, and Deutsche Bank said something different. They said the following: in our reading, expectations that large beats and raises would continue, arguably justifying high multiples that are seen only in the early stages of economic recovery when the market price is in a recovery in earnings. Can I get your perspective, your view on that, Emily? What you think is keeping multiples elevated? Is it the low interest rate story? Or is it just that classic early stages of a recovery where you price in the beat and raise, the beat and raise?
I think the interest rate, the low interest rate, and the, Tina, there is no alternative story is certainly part of it. But I keep coming back to the impact of this massive liquidity and of increased retail flows. When the market had that slight downturn after the Omicron variant was announced, we saw massive retail inflows into the market. In fact, records. And so, I think it's going to take that's money that flowed in quickly, and I've said this before, and could potentially flow out quickly, but that is putting a floor on markets. And just the sheer amount of still retail excitement and flows into equities.
Emily Hill sticking with us alongside Tony Rodriguez. Coming up, the president expecting supply issues to start easing up.
Prices have gone up because of supply chain concerns. We've worked as hard on the supply chain concerns. I think you're going to see, you've already begun to see, and you're going to see over the next couple months, oil prices, prices of gas pump come down.
More on that conversation still ahead from New York City. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
in any doubt, there is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
The UK's Boris Johnson issuing a warning as the Omicron variant spreads. This as fresh COVID cases spark factory closures in China, with corporate filings showing that at least 17 listed companies in China's Eastern Manufacturing Hub have suspended production. For more, let's bring in Michael McKee for a whole lot more on this. Mike McKee, it gets tougher.
It does get tougher. The problem is, in China, it's still the Delta variant that is causing problems. Omicron not hit yet. They're watching for that, but we're seeing China's zero COVID policy in action. An outbreak of COVID cases in the Chinese coastal province of Xinjiang is at least 192 of them, they say, in the last 12 days, has led to neighborhoods being sealed off, people unable to leave their homes. The bad news for the global economy, as you mentioned, 17 companies shutting manufacturing plants at the request, as they put it, of local authorities, and that's raising questions about interrupting supply chains. Among the companies, makers of electronics, LED lighting, auto parts, ventilation equipment, and chemicals. How bad any interruptions are will depend on how well the authorities can interrupt transmission of the disease. So far, as I mentioned, this is the Delta variant. Omicron could cause even more problems. China's strategy is to isolate, test, and trace as fast as possible to snuff out the disease when outbreaks happen, no matter how many people are affected, something that doesn't work for Boris Johnson and the UK or the United States. The good news so far, the huge Ningbo port in that Zhejiang province is still operating okay. It is the world's 3rd largest, and you remember it was shut down when 1 case of COVID was discovered there in August. So we're sort of hanging on the precipice here to see if supply chain problems get worse.
The tolerance level in China, as we know, Mike, very, very different to what we experience in the United States and much of the Western world. Mike McKee, thank you, sir. This from Citi over the weekend. Continued supply chain issues and an ever tighter labour market present upside risk to both goods and service prices in the coming months and beyond. They go on to say, we continue to expect the Fed to double the pace of tapering to $30 billion a month at this week's FOMC meeting. With us for more, I'm pleased to say, is Tony Rodriguez, Emily Hill, Jerome Schneider of PIMCO joins us now too. Jerome, I want to come straight to you, sir. What all of this means for the Federal Reserve this Wednesday, your view, please.
Yeah, absolutely. Well, basically, we all know that tapering is in the forecast here, and really what that means is for the markets to focus on life after the taper. From this point of view, they're going to try to find a path for policy to return to a more neutral policy metric. And that's going to take quite a while. And I think one of the things that has to be taken into the consideration is that we all know rates are probably going to move higher through the course of 22, 23, and 24, but the sequencing is of the utmost importance. Just because they simply have taken it into transitory doesn't necessarily mean that the transitive properties of inflation are necessarily thrown out the window. As we all know, if A equals B and B equals C, then A has to equal C. The Fed is going to try to extrapolate that in a variety of ways and see how much inflation is actually baked into the longer-term expectations of consumers and end users, and that's going to be the key metric which ultimately delineates the forward path of rates, which are actually pretty high in the front end at this point in time.
So, Jerome, I see 2 camps right now, and I can identify which one you're in. There's this one camp that believes this is just about building in flexibility to go one way or the other. There's another camp that believes this is about a straight line towards rate hikes at some point next year, and that's why they need to go quicker to tee that rate hike up. Why is it not the latter, Jerome?
Yeah, well, I think ultimately, when you think about it, Jonathan, camps are meant to pick up and move at various points in time, and that's what the Fed is prepared to do. We ultimately are recognizing the fact that the path to normalcy does begin with a sequencing to increase tapering, to eventually increase rates, and that's going to take some time. But if the foundation of these higher inflation metrics don't actually persist for a longer period of time, they are going to take a longer road. That camp is going to take longer to move, and folks are going to have to be adjusting those expectations longer run. So I do think we're in a fully functional Fed, which is going to optimize to what they see over that medium-term horizon into 2022 and beyond. And while we might ultimately get very much close to that neutral rate and the 2.5% growth rate that we would expect in 2024, it's going to take some time, and it's not necessarily baked into the cake at this point in time.
Tony and Emily, you both brought up difficulties with China. The Omicron variant might be a difficulty for China's future. Supply chains are here. Right now, they are issues, and they could get bigger with that in mind. Emily, I just wonder, from your perspective, how difficult it is for a Fed to make a move, given what it's seeing abroad right now, in China and elsewhere.
Well, I think it definitely ramps up the pressure on the Fed. And I think, we have to remember that China in the last few years has contributed 20 to 25% to global GDP. And, I think that China's in a little bit of a jam right now. And I think one of the things that continues to interest me is the Chinese government has been very frugal in its response to COVID. It's been draconian in its societal measures to keep the disease under control. But they put something like $900 billion in injection into the economy, which is around 6% of GDP. You compare that to Western developed markets like the US, we put substantially more stimulus into the economy. And so I think, it continues to be a bit of a puzzle and therefore fairly unpredictable. And I think that's why I would agree. I'm in the camp that thinks that the Fed is trying to build in optionality here.
Tony, are you in the same camp?
Yeah, Jonathan, I am. I mean, obviously optionality is always a good thing, but really in this environment, it's almost imperative. And that's because they face such a tremendous amount of uncertainty, and really on three pretty important fronts. It's COVID, which we were just talking about, and the implications there, as we're seeing now in China with the factory shutdowns, but also with respect to inflationary pressures and whether they will moderate in the second half. And maybe most importantly, with respect to labor force pressures, unemployment rates dropping quickly, and the Fed is really still expecting, maybe hoping, that we're going to see an increase in the labor force participation rate, which will moderate some of the pressure coming in the labor market. If we don't see that, if we do see more restrictions from COVID that impact the supply chain, if we do see a greater persistency late into the second half on inflation, then that optionality is going to be pretty critical with respect to being able to respond to any of those three moving in a direction that's currently unexpected and difficult to forecast.
That word optionality, the word flexibility, Jerome, I want to come back to you on that. And in just a moment, we'll talk about your market calls too. But before we get there, do you think they have some flexibility around the sequencing of what they're about to do? You mentioned that word sequencing. Do they have flexibility on that too?
They do. And one of the things that has been quite successful is that the communication has worked. It is working and will continue to work, provided that they continue to adapt to that framework. No one's asking them to be a stick in the mud, but the market is asking them to keep the market updated on how the paradigm in their minds does effectively change. From the Fed's point of view, the number one thing they want to do is not arrest the recovery. They don't want to arrest it by moving in an unexpected manner. They don't want to arrest it by moving too hawkishly. They don't want to expect it by pricing in or having the market price in too many Fed hikes along the way. But by communicating, by adjusting the dots, they have a very formidable way to manage those expectations on a go-forward basis. So if you want to call it optionality, fine, but at the same time, it's a Fed that's going to be adaptive and give themselves the leniency to adapt to that changing inflationary metric as we see it potentially moving higher, for sure moving higher over the first quarter and second quarter of next year, but then gradually eroding in the latter half of 22 and 23. And that is the tension that the market is going to have to digest. That's where liquidity comes into question. That's where market volatility comes into question. And that's where, frankly, risk appetite comes into question for investors over that medium-term period. And so how much you want to really bank on the Fed moving too quickly or too slowly also goes hand in hand with the volatility you should expect in the markets during that point in time.
Well, let's tee up your broader market call. Just tee it up just a little bit, a tease for later in the program if you can, Jerome. But ultimately, why you want to be liquidity providers into next year, liquidity providers and not be on the demanding end of it.
Yeah, you hit the nail on the head, Jonathan. Liquidity providers are what it's about. We're in a market where ultimately Fed will hike rates in mid to late 2022, probably 1 or 2 times, and then sequence beyond that. But more importantly, for those investors sitting on the sideline right now, we know that cash rates are still zero, and they're going to likely remain that way for another 6 to 9 months. And that's the damaging effect when you're pricing in inflation, when you're having eroding purchasing power. Ultimately, we have to find ways to put that money to work. What I highlighted at the previous point of the segment was that short-term interest rates are actually high. And what I mean by that is the forward rate of expectations for the 1-year point in 2 years, which I know is a bit into the weeds, but it's a very important metric here because it does highlight that a lot of the expectations of Fed hikes are actually priced in over that medium term, over the next course of the 1 to 2 years. And there's ways to take advantage of that without simply sitting in cash on the sidelines. So that's number one. Number two is that markets will remain fickle in the middle of 2022 and into 2023. As tapering occurs, as liquidity conditions continue to evolve, as geopolitical concerns evolve, we're going to have to be poised to really take advantage of the liquidity in the market, be those liquidity providers. And simply because there's a vast amount of cash sitting on the sidelines doesn't mean it's in the right places. And so ultimately for investors, it's the ability to pivot, find ways to put cash to work, and more importantly, be a liquidity provider, as you noted here. And so being poised to be defensive right now and opportunistic in the future is key and essential over the next few years.
Liquidity isn't in the right places. I want to return to that in just a moment. Jerome, Emily, Tony, sticking with us. Coming up, the morning calls and later, two strategists with two diverging outlooks, seeing eye to eye about the depth of a potential sell-off next year. That conversation still ahead. From New York, this is Bloomberg.
Urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minutes away from the opening bow from New York City this morning. Good morning. This equity pickup fades this morning. All-time highs at a close on Friday, biggest week of gains since February, and now just about in negative territory on the S&P 500, down a single point. Let's get to your morning calls. First up, UBS downgrading Merck to neutral. The analyst citing headwinds to key growth drivers with a lack of catalysts eroding the stock's bull case. JP Morgan upgrading Coca-Cola to overweight, expecting reopening efforts and pricing trends to deliver top-line momentum next year. And finally, Cowen naming Amazon its best idea and top mega-cap stock for next year, expecting revenue growth to accelerate as it starts lapping easing comparisons. Up next on the program, Apple getting closer and closer to a $3 trillion market cap. From New York, this is Bloomberg.
60 years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops, tanks, guns, UAVs. Clearly, neither side are taking any chances.
Breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell in New York City this morning. Good morning. What a week of gains last week. About 3.8%. Biggest week of gains we've had on the S&P 500 going back to February early this year. Going into the opening bell this morning, we fade, roll over just a little bit, negative 1/10% on the S&P. We're down about 5 points. There's your opening bell. Switch up the board and get to the bond market. What a week we've got coming up for you. A Fed decision on Wednesday. The ECB and Bank of England this Thursday. Into the bond market, yields in 4 basis points. This is the debate we're having in the equity market right now. The big inflation story, 6.8%, is not translating into higher rates, higher yields, and that's why Jonathan Golub at Credit Suisse, one of the reasons why anyway, he's still constructive. In your FX market, euro dollar just below, south of 113, 112.92 and down 0.2%. Crude at 71.30 and negative 0.5%. And around the opening bell, we're down 1/10% on the S&P 500. Information technology, top of the pile, up 0.2%. Healthcare, utilities, they outperform. Energy, underperforming, down about 0.7%, giving you an idea of the tilt in the early part of the session. One name we're looking for, it's Apple, getting closer and closer to that $3 trillion market cap. All over that story is Bloomberg's Abigail Doolittle.
Good morning, John, and all eyes on Apple indeed, as it potentially is going to hit $3 trillion in market cap this morning, perhaps. Let's see, shy of it right now. The stock is up about 1%, a little bit less than 1%, up now 1.24%. So let me do a quick calculation here to see if it has hit that mark. No, 2.98 trillion, not bad, given the fact that it first flirted with 1 trillion in 2018, cleared it very decisively in late 2019, 2 trillion after the pandemic. That's a long way, John, of saying that Apple has more than tripled in just a little more than 2 years. That's the world's largest company, really incredible, taking out the likes of Microsoft, Amazon, Google, Facebook, Tesla, all in the dust. And over the last 3 weeks, there has been an incredible 20% rally over those last 3 weeks, even though there's a likelihood that the iPhone sales are going to be tight in this December quarter on supply chain issues. But it all comes down to profitability, because their revenues are expected to be at a record as they make it up in other products, services, and profitability. Speaking of, Apple is the most profitable over the last 12 months, nearly $95 billion, beating Berkshire Hathaway, Alphabet, Microsoft, JP Morgan. Again, all eyes on Apple. John, will it or will it not clear $3 trillion? And if it does, you can bet there should be another nice rally for the markets overall today, John.
Happy, thank you. On the surface of things, this is a stupid game. Watching the market cap of a company get to a round number, it's 2.96 trillion right now for anyone who's playing it. But beyond that, it's important. It was only 5 minutes ago we were talking about 1 trillion. And the S&P 500 breakdown, the member weightings right now, Apple is more than 7% of the S&P 500. That's a massive change. I want to bring in Emily Hill if we can, just to reflect on this, respond to it. Emily Hill, it was only 5 minutes ago we were talking about a $1 trillion name on the S&P 500. Now it's 3. We have a 7% weighting on the S&P. What do those kind of things mean to you at all, if anything at all, Emily?
Well, I hate to be a downer, but Apple has returned 62% per year over the last 3 years, and it's 45% over the last 5 years. And I think Apple, as you just showed with these incredible revenue numbers, it's not, it's going up for a reason. But I just want to point out, as I continually have, that the S&P 500 is overvalued by almost every measure, aside from the equity risk premium. And at some point, there's going to be a reversion to the mean. As I've said, there are a number of factors that are continuing to prop up the market, and Apple is an incredibly well-run company. But frankly, I would be a little bit cautious at this point about expecting those kinds of returns over the next 3 to 5 years. And I think that there are a lot of companies in the S&P 500, those 5 to 10 companies that make up, 40% of the index. I think we've got to be cautious about our expectations for all of those because they've just been on an absolute tear.
Emily, you've said it a few times now. We've had 5 to 6 years worth of returns in a single year. Apple's been a big part of that. Apple is on pace to become the first $3 trillion market cap company this week. This came from Dan Ives of Wedbush, as the street is starting to better appreciate the robust fundamental story into 22. Hitting $3 trillion is another watershed moment for Apple as the company continues to prove the doubters wrong. Right now, about 2.97. Tony, just quickly, return assumptions. How do they have to adjust from here into next year?
Well, Jonathan and Naveen, we certainly think there's going to be lower returns in 22 than this year. So Emily makes a good point. Equity markets certainly can't be described as cheap. So with the valuations where they are, we're expecting more of an upper single-digit return number out of the equity markets rather than double-digit returns. When you look at fixed income, some of the upward pressure that we expect on rates is clearly going to put a lid on what returns can be. So the positive read-through, though, from the Apple commentary is that it reflects a pretty positive, healthy environment for corporate America from an earnings and cash flow perspective. And that is positive from a credit risk perspective in the fixed income markets. So as we look at it 22, we do think we're still going to see a pretty positive credit market environment. Defaults are going to remain low. Earnings are going to remain healthy. So while investors are a little cautious on the equity market given valuations and they have difficulty finding income in the fixed income markets, it's the credit markets across multiple segments that we think is really one of the attractive solutions for an investor in 22.
And one thing you've said repeatedly this year, Tony, and I want to bring it up again, you think the market right now, the price of the story, reflects fundamentals and not excess optimism. Tony, I've heard you say that a few times. What backs that up?
Well, primarily, it's really in the fixed income markets. What backs it up is the actual results, both on the balance sheet and income statement for companies, and then on the resulting kind of credit metrics that we see. So default rates, which are at very, very well below historical averages, we expect to remain there in 22. And you're seeing a significant cycle shift to an upgrade cycle from a credit rating agency perspective. So credit quality is remaining steady to improving, and that's leading to that story that we're really pricing to a positive credit reality rather than necessarily an inflated or excessive optimism around credit health.
Well, that's the constructive view on the credit market. Here's the constructive view on the equity market. Goldman, downplaying the risk of a major stock drawdown, they say the following: the macro environment does not suggest drawdown risk is elevated in the coming months. Nominal and real rates are expected to rise but remain low over the coming months, supporting the backdrop for both valuation and equity demand. Bloomberg's Kaylee Lyons joins us now for more. Hey, Kaylee.
Hey, John. Yeah, the team over at Goldman doesn't see the market declining by more than 5 and 10%, and ultimately is going to have single-digit returns next year, ending the year at 5,100. And of course, that's on the more bullish end of the spectrum. At the bearish end of the spectrum is Mike Wilson over at Morgan Stanley, who sees the index dropping 6.6% to 4,400. But again, at 6.6%, that's not a major dramatic correction either. So the real difference in opinion may just be over whether or not a moderate pullback will be bought, and Goldman leans on the side that it will. Now, all that said, Goldman isn't the most bullish on the street. That title now belongs to John Stoltzfus over at Oppenheimer, whose year-end target for 22 is now 53 330. That is 21% above Morgan Stanley at the low end, and that's the second widest gulf between strategist targets in the last decade. It goes to show you how hard it is to find consensus in this environment. Now, if you take all those scattered forecasts and average them out, you get something nearing 4,900, which would represent a relatively muted gain of only about 4% for next year. We have only seen a gain of between 0 and 5% 4 times in the last 30 years, while in 16 years, in the last 3 decades, we've seen double-digit returns 9 years with equities up more than 20%, and only on 5 occasions has the index dropped by at least 5%. So whether it's to the downside or to the upside, next year's moves may look a little unremarkable, John.
Kelly Lice, thank you. Echoing some of what we've heard from Emily Hill this morning, Jerome Schneider of PIMCO back with us. Jerome, I want to build up on what you said last time, around about 5-10 minutes ago, when you said you want to be a liquidity provider. Then we talked about where the liquidity was. We talk about being awash with cash, liquidity everywhere. You talked about liquidity not being in the right places necessarily. Just build on that for us if you can, Jerome.
Yeah, absolutely. You know, I think when you try to extrapolate what's going on in the conviction in the market, as you mentioned just a moment ago, there is a wide and divergent estimate of where the market is going. And I think that has led itself wide not into a quantitative element of risk premiums being built in the market. There is a tension and a tentative nature of how that's actually going to be taking, how investors are going to take advantage of it. You can see that there's over $4 trillion sitting in money market funds, and those have been there for quite a while, but we're now near and at historic highs for money market funds. And while we can see some of that cash being deployed, specifically cash in that corporate market from corporations looking to deploy into capital expenditures, et cetera, there's going to be a lot of defensive investors still sitting on the sidelines. And so from that point of view, that's the ultimate point to be defensive, to create optionality in portfolios and to be that liquidity provider. And in fact, what we mean by that is earn premiums when markets become tentative, be in the market for asset classes that you do like and provide a bid and go into the market and take those in bite-sized risk appetites. And so from a fixed income point of view, we view short-term fixed income to be that ballast, to be a volatility reducer in terms of overall portfolio construction, but also give you that pivot, the optionality to be that liquidity provider once there becomes a clearer path with regard to outlook, growth estimates, and ultimately where we're going to be going with the Fed over the next few years. And so that's going to be the tension that's going to create an opportunity set for those investors poised to take advantage of liquidity. The second thing I think, which is the key here, is the structural element of the market, Jonathan, which is ultimately, because there's simply a ton of cash sitting on the sidelines, it doesn't necessarily mean that markets themselves are deep or have the depth so that we're used to many of the conditions that we've witnessed over the past 20, 30, 40 years of tight bid offers, deep liquidity from market providers, et cetera. And especially as we sit here today, close to the holiday season and just on the precipice of the new year, we recognize the fact that many of those traditional liquidity providers aren't going to be willing to dedicate capital and balance sheet to that regard. So we have to be on our toes, not just for the immediate future, but for the foreseeable future as we begin to adapt to not only the seasonal effects, but also what's going to effectively happen with the Fed going into 2022 and beyond as we get to a more neutral policy posture from them.
Jerome, what's interesting about this call from you and the team at PIMCO is it's a call on market conditions. You're calling potentially for so-called gappy markets. And Jerome, for people who might not have experience dealing with that, might not understand what you mean by that, can you give us an example of what you might be expecting in the not too distant future?
Well, perhaps you're calling me old, but I won't take it personally. But I would say that the following is the case. The reality is that over the past 10 years plus, we've been the beneficiary of exceedingly liquid markets, easy monetary policy, and easy financial conditions. And that may not necessarily persist for not only the next year, but maybe not even the next decade. And so while the Fed will remain vigilant with regard to their mandates of employment and inflation, liquidity conditions, and more importantly, how it translates into the actual market functioning is something that investors are going to have to contend with. So higher transactional costs, bid offers between any asset classes which are wider, these are not only things that people should be defensive and defend against, but it actually creates opportunities for active managers like PIMCO and other managers who are poised with an initial condition of a high degree amount of liquidity. And that's really what we're recommending to investors, is that on the precipice of higher rates, recommend that investors ultimately have the ability to flex around any overshoots in rates, any overshoots in risk appetite, and reallocate necessarily according to that. So making sure liquidity is in the right place on a portfolio level is essential at this point in time, despite what the tremendous amount of liquidity in the overall system is right now.
Jerome, smart, as always. Jerome Schneider there of PIMCO, together with Emily Hill and Tony Rodriguez. To the three of you, thank you so much for this morning. To kick off a big week ahead. Coming up, Democrats looking to clear the way for the Biden agenda ahead of the holidays. The latest developments down in D.C. is coming up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
この短期間に一気に上がってしまったので、正直きついのはきついです。先から灯油の単価が上がるよと連絡があったのが10月の初め頃。当初はこんなに上がると思ってなかったんですけど、初めに5円上がる。その先10円。で、その次に3円上がる。で、また今日ちょうど2円上がったので、ここを銭湯ついでから20円ほど上がってしまったんです。
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Should revote. The vote in the House was based on a fraud. This bill doesn't cost $1.75 trillion. It cost almost $5 trillion. It doesn't add $300 billion to the deficit. It adds $3 trillion. There is not a plan to pay for it. If there is, I missed it. So give it to me. Give it to the American people. Before we vote in the Senate, Build Back Better will be gasoline on the inflation problem. The last thing I'm going to do is add more burdens to working families.
Republican Senator Lindsey Graham there highlighting inflation as a concern for President Biden's Build Back Better plan. Majority Leader Chuck Schumer had this to say.
You want to talk about inflation. You want to talk about people having to pay more. This bill is an antidote in so many areas. Childcare, healthcare, and housing, just to name a few. Cutting costs for working and middle-class families. So we're going to keep working and getting this bill done. We are still on track to vote on a final product before Christmas.
Joining us now is Bloomberg's Joe Matthew. Joe, let's start there. A final product before Christmas, really?
Jonathan, I think it would take a Christmas miracle for that to happen, and there's just so little time for a breakthrough here. As we consider what's going to take place in the next couple of days, it's a good time to consider what we know and what we do not know. For starters, there's no bill. Lawmakers are still hashing out the components of this. There's still no SALT deduction deal, for instance, and the Senate parliamentarian still has not ruled on what will be allowed and what will not be allowed. That's going to be a critical moment when the parliamentarian rules on all of this. You mentioned Joe Manchin. Before we actually get that far here, there are other items on the to-do list. Lawmakers are streaming back into town today. They have to deal with the National Defense Spending Bill. They also still need to codify and vote on the debt ceiling deal. Both of those are pretty big deals. Now, we do know that Senator Joe Manchin, while all of this is happening the first half of the week, is going to be meeting with President Biden. That could happen, Jonathan, as soon as today. And they've got some things to hash out. This will be the first time they speak, and maybe it will end up in a breakthrough, but the first time since that CBO score that Lindsey Graham just mentioned was released late Friday. And it shows, again, that this deal would add some $3 trillion to the deficit if programs are extended over the course of 10 years and not paid for. We'll see how this ends up here, but I don't know if we're going to have a present under the tree for Joe Biden. It might bleed into early next year. That is, Jonathan, the conventional wisdom in Washington this morning.
If he doesn't get a present, the other side will. Joe, thank you. Joe Matthews, good to catch up, as always, on Stand On Bloomberg Radio a little bit later. With us now, I'm pleased to say, is Chris Marr, Chairman and CEO of Ocean First Financial. Chris, it's been too long. We've talked about these supply chain issues. You've got perfect visibility into corporate America, what they're doing, what they're struggling with. What's the update, Chris?
Well, great to see you, Jonathan. Look, supply chain's getting a little bit better, and by that I don't mean that things are showing up on time, but they're becoming a little bit more predictable. So you may have extended delivery times, but you can at least work around them, and you can kind of build your business around that plan. So that's getting a little bit better, a little bit more visibility. But inflation is settling in. So our clients are seeing this kind of long-term inflationary pressure. They're starting to make business decisions based on that, whether it's how they deploy capital, how they think about labor, how they think about different assets and classes of, say, commercial real estate. So supply chain's getting a little better. Decisions are being made. People are making investments. We're seeing robust economic activity. So things are kind of getting there, but it's taking time.
Chris, how much tolerance is on the other end when they try and pass those costs along through higher prices? Is there still a lot there, Chris?
Yeah, so unusually, what's very different about this period as opposed to prior periods is you would have like a fuel surcharge on a transportation bill, and there would be a fight over that, right? Customers are happy to pay the slightly higher prices as long as they get certainty around delivery. So I think you're getting to the point where you may have a little bit of structural inflation here, and especially expectations around labor, right? People are willing to hire at higher rates. They're willing to pay that price to get the labor, but that's going to be a cost that continues on, is going to grow in future years. So price increases for now are being passed through to the consumer.
And Chris, this is important for your business, because what we've seen at many banks in America right now is business lending hasn't picked up, and business lending hasn't been picking up because they can't build up their inventories. These companies can't build up their inventories because they can't get the supply from abroad. Chris, has that improved over the last few months going into year end and into next year?
It's improved a little bit, John. So what we're seeing is we still see record low utilization of commercial lines. So to your point, our customers are not able to get the products. They're not spending the money. They're not drawing the lines. So that working capital isn't as needed. But we're seeing very strong demand in long-term capital projects. So, for example, we're in the process of financing a very large medical laboratory build-out up in the Boston market. And that shows you that people are willing to make multi-year, very large capital commitments. And some of that is because capital is, it's going to be better than labor. If you think about, if you have choices between capital and labor over the next, 3, 4, 5 years, capital is going to win.
Chris, how difficult is it for those clients to plan? And for you specifically as well? How difficult is it to plan in corporate America for next year and beyond through 5 years?
Yeah, I don't think anyone can plan out 5 years. We do our best to plan out the next, say, 18 months in an environment like this. It really is a challenge because as you make those longer-term investments, you want to make sure the demand will be here. And I think everyone feels certain the demand will be here in 2022, likely into 2023. Of course, we're watching your last segment to see what happens with the infrastructure bill, because that'll affect demand a lot. But it's the longer term, 4 years, 5 years. It's just too cloudy now. You don't know what interest rates are going to be like. You don't know what inflation will be like. You don't know. We don't know if we have an infrastructure bill. So short term, I think we can get to loan demand is picking up. We're going to see among kind of the strongest loan demand periods in the back half of this year, but we need more in 2022.
Chris, always lucky to catch up with you, sir. Christopher Mather of Ocean First, just giving us some insight from a banker's perspective into what's happening right now in corporate America. What's happening right now in this equity market is the S&P 500 down 0.4%. Energy leading the move lower, down by a little more than 2%. Utilities, healthcare, real estate, staples, top of the pile. Just gives you a feel of how defensive we are this morning. Your yield curve is flatter too on 10s. Yields are lower by about 3-4 basis points, down 4 now to 144, going into a massive week for the Federal Reserve. More on that in just a moment. Up next, your trading diary.
Will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should...
We're down 1/3 of 1% on the NASDAQ. Going into the Fed, here's the bond market. 2s, 10s in the 70s right now. That spread between the two. The last time we started a rate hiking cycle was the back end of 2015. And the rate curve, the yield curve, well, the spread between 2s and 10s was north of 120. Yields are up at the front end again to about 66 basis points off the highs of the year. Your 10-year yield well off the highs of the year. Right now, 144.11. Yields coming another 4 basis points. All the talk of higher inflation, higher rates is not translating into high yields at the long end. What does that mean for this equity market? We'll get into that through the week. Let's get into this week. Your trading diary, what you need to be looking for through the week ahead. The Bank of England releasing its financial stability report and stress test results, 12 p.m. Eastern. US PPI coming up on Tuesday. Retail sales Wednesday, plus a Fed rate decision and Chairman Powell news conference. And finally, the Bank of England and the ECB with their own rate decisions on Thursday. From New York City, looking forward to covering those events with you all. Thank you very much for choosing Bloomberg TV. For our audience worldwide, this was the Countdown to the Open. This is Bloomberg.
front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It said in disaster response and emergency response that the real first responders